uncertainty affects the economy in a variety of ways.
The economy is much better shape than people think.
The economy slows, but doesn't tip over into recession.
The choppiness that we're talking about, we will come through that hopefully with stronger economic elements on the other side.
We're calling this the summer of mud. It means that we're just stuck in this muddle through.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Well, the summer of mud doesn't look so bad. Good morning. Welcome back to Bloomberg Surveillance. It's ISM Services Wednesday ahead of jobless claims Thursday and payrolls Friday, barreling toward a new bull market, with the S&P 500 surging nearly 20% since April 8th. Tech darlings basking in the spotlight once again. Investors rekindling their love affair with all things AI, shrugging off worries about tough rhetoric between the U.S. and China as ongoing budget squabbles continue in Washington, D.C. Damian Sassower back on the hot seat for the hour. Thank you so much for being with us. Is this what a bull market feels like?
Well, I don't know. I mean, Eric Robertson's on the tape talking about a bull market, not in equities, but in fixed income and FX. He thinks that lower oil, weaker dollar, the fiscal stimulus that's coming out of China, the U.S., EU, as well as all the monetary stimulus in emerging markets, money markets are mispriced here in the U.S., and so I can't really disagree with him on that.
Honestly, it's sort of this tale of two worlds. Either we're talking about suddenly a recovery, that where all the best case scenarios come to fruition, we get some trade deals and potentially the resilience of the U.S. economy keeps powering it along, or you get a slowdown in growth that gives the fixed income bull market. So has everyone forgotten about the bill in Washington, D.C. that Elon Musk yesterday called a disgusting abomination?
Well, I think the equity markets have forgotten about it. Certainly if we ask our guest that, I'm going to surprise you. But I mean, basically, yeah, no, it looks like the equity markets and many of the companies that should be primed to benefit from the big, beautiful bill are just not reacting the way they should be. And we'll see if there's still some premium left in those stocks and in the sectors that are supposed to do well.
In the meantime, I was going to call it Beige Book Wednesday, but I didn't want to get that much hate mail. I am curious about what the data is actually telling us about how much people are primed to celebrate anything that isn't bad. The fact that we got a job openings data yesterday that came in higher than expected, this is messy data. People have undermined it for years. The fact that people were looking at that saying, oh, quits rate was solid, it's fine, even though it ticked down just a touch. Does that give you a sense that right now the bias and the indication for this market is to creep higher?
Well, it's going to be interesting on Friday with payrolls just to see which parts of the labor force are doing well and which ones aren't. Is healthcare actually, doing well? Did it do well in May? Which ones aren't? And so, I think you're right. I think there's a lot underlying a lot of these data prints. There's a lot of information there that the markets have yet to kind of really react to, and there's a lot to learn from.
Right now, what we're reacting to is everything positive. That seems to be what's going on in markets. We can see equity futures indicated upward. They're not even trying to go down as they had for the previous 2 days. Just adding to some of the gains, the best two-day rally in about a month, which you could see is adding to that with a 0.2% gain on the S&P. A little bit more dollar weakness. This has been a story that has been ongoing despite that bull market that we seem to be approaching with nearly 20% gain since April 8th. 10-year yields just marginally higher, creeping up, not yet seeing that bull market in fixed income and crude just marginally higher. So let's get to that guest. Coming up, we've got Savita Subramanian. We're so lucky to have her of Bank of America following back-to-back gains on the S&P. Wendy Schiller of Brown University as Trump doubles steel and aluminum tariffs, and Michael Reid of Royal Bank of Canada, RBC, counting down to May payrolls. We begin this hour. Stocks holding on to 2 days of gains as traders await more labor market data. Savita Subramanian of Bank of America writing this. Although the S&P 500 has round-tripped back to near levels we saw at the beginning of this year, benefits may not be fully priced to particular areas of the market. Savita, thank you so much for waking up early and being with us here this morning.
My pleasure. This is great.
So let's start with what you make of the rally that we've seen so far. This 20%, almost 20% rip-roaring rally that's just come as a drip feed of bad news stays out there.
Yeah.
But the good news has been corporate America.
Exactly. I mean, I think that's the story, is this decoupling of U.S. government policy uncertainty with the corporate sector, which is actually relatively nimble in navigating policy changes. They just need numbers. And I think that's where we are now, is this environment where companies have been able to manage a lot of pressure to margins over the last few years. Today, they're saying they can handle tariffs better than they could back in 2018. A lot has changed since Trump 1.0, but I don't think that companies are getting credit for the idea that they've managed to maintain margins during this massive inflation and rates shock that we've seen already.
Have we actually seen it, though? And I think that that's really the key question. Have we really understood the scope of what these changes could mean, given the fact that we don't know what these changes are still?
We still
there is
don't know.
About a month left in these negotiations.
Yeah.
And there's increasingly heated rhetoric between the U.S. and China, let alone a question about whether this bill will even get passed.
Yeah, I think there still is a lot of uncertainty. And I think, I guess when I look at uncertainty, I don't think that we're at new levels of uncertainty. I think that we've always been in an uncertain environment. And, for the last 20 years, it's been kind of unnerving that interest rates have been falling to these uber low levels. And we've been kind of worried about how we're going to get off of that zero bound. We're off of it. We've seen corporations exert efficiency gains. So I think we've seen a lot of proof of concept that corporates can handle uncertainty. I think when I look at earnings season, what worries me is that companies are in a little bit of a kind of pause mode. So if you think about committing new capital to projects, it's really hard to do that right now, right? I mean, it's really hard for us to do that as consumers. So I think that there's an environment where you think about inflation uncertainty, you think about this sort of global, who are our friends, who are our enemies in the U.S., and it's all changing at a very rapid clip.
So who are our friends and who are our enemies in the equity market? And by that, I mean your team's done a ton of work on the companies that are poised to benefit from Trump's big, beautiful bill, right?
Yes.
I think you said those companies would have a high beta to real year-over-year wage growth.
Exactly.
So talk me through those companies. Talk me through why they're not performing the way they should in this environment.
Right. No, I think it's interesting because, there's been this narrative that the U.S. consumer has to roll over because of all of these curveballs thrown, like, higher interest rates, the depletion of savings from COVID. The U.S. consumer has done pretty well. Yeah. The only area that we've seen fraying is that lower income cohort. And I think that cohort is still pricing in more risk than benefits. But when we look at the big, beautiful bill, it's actually quite friendly to that lower and mid-income cohort. So if you think about more take-home pay from no taxes on tips, no taxes on overtime, if you think about even, the SALT cap, the SALT reductions were capped at a certain income level. So it does seem to be skewed more towards President Trump's base, which has been the one area of the consumer spectrum that has been showing signs of weakness. And, that's where inflation is felt most acutely.
A few weeks ago, when we spoke, the world was in a very different place. Certainly the equity market was. I mean, vols were considerably higher than where we are now. And you rightly pointed out that this might be the right time to, write some equity protection, take on some income. What about now? Where are we now? Because, to me, I look at volatility in the FX and the fixed income markets as well, and it's relatively well behaved. I'm just curious to hear what your team is seeing there.
Yeah, I mean, equity volatility, I think, is going to remain at a higher kind of run rate over the next few years for a number of reasons. One is the fact that we have been in this ample liquidity flowing into equities environment. And now we're starting to see liquidity withdrawn. And that's the number one reason that you see volatility tick up. I think that the S&P 500 is well poised for that environment because if you look at corporations since 2008, what they've done is get higher quality. So they've paid down debt. They've sort of locked in low fixed obligations over a long tenure. So we're in an environment where I think you've got a corporate sector that's really healthy, very high quality from a balance sheet perspective. Corporate earnings have kind of decoupled from a lot of these credit indicators. So, my sense is that volatility could remain elevated, but it's not necessarily an environment where you want to sell all equities. In fact, a lot of equities could do really well in this sort of inflationary backdrop. And, going back to your point about extremes, we've either been extremely bearish or extremely bullish. I think you're right. I think we're in this environment where all we're thinking about are the tails. And there's this big middle ground, which is the base case, right? I mean, normally we're in kind of a Goldilocks or a pseudo Goldilocks environment, and I think that's kind of what's in place right now. If you think about inflation levels, if you think about average hourly earnings, real wage growth, the jobs market, not too hot, not too cold. The Fed's not cutting, the Fed's not hiking.
Hold on. You're saying that right now this is Goldilocks.
I mean, it doesn't feel like
Goldilocks.
It doesn't feel like Goldilocks.
I'm curious. It's one thing if it's Goldilocks right now.
Yeah.
But equity markets, as you know, are a forward-looking instrument.
Yes.
So you have to try to game out some situation.
Yeah.
And good luck coming up with the parameters for that situation. What is this new normal? I mean, are we looking at higher inflation, lower growth? At what point does that become punitive? And does that really change the scenario for an equity market that grew up under the tutelage of a Federal Reserve that was really easy and that was really kind of gifted by this idea of low inflation for a very long time?
Yeah. Well, here's the thing. High inflation doesn't always have to be accompanied by lower growth. In fact, most of the time, higher inflation is accompanied by higher growth. And I think that's what we could be moving into. I mean, when you think about most environments, inflation has actually been good. It's only during these very rare stagflationary environments that inflation has gotten too high and has actually started to choke off growth. And I don't think we're there. I mean, I just feel like we're at a point where there are puts and takes. There's efficiency gains from tech that are going to put a cap on inflation. I mean, tech is disinflationary and it's still in force, right? Think about disruption around professional services jobs. That's disinflationary. But then you've got this tighter immigration, a tighter labor market, which is potentially inflationary. So there are puts and takes in most of these areas of the economy. Oil has come down a lot.
So in other words, if the bond yields out there that are rising have scared some people, how much can you say to them, don't let this scare you? Because this is bond yields rising and bond prices falling. The right reason, not the wrong reason.
I think that's right. I mean, when you look back over history, bond yields aren't really that high today. And I know this sounds crazy, but pull it up on the Bloomberg, pull up, 10-year yields going back to the 50s. We're kind of average. And if you think about real rates, they're not necessarily at levels that would make me worry. I mean, I know this is weird coming out of a zero interest rate environment, but I think we're just anchoring to the last 20 years and not necessarily thinking about, the full spectrum.
We are going to carry that conversation forward because there's a big question about, yes, it's not that strange. At the same time, the rest of the world has started to look very strange with valuations.
That's true.
Does that start to check?
Real yield differentials with the U.S. are widening and the dollar's declining.
So you
get a rate strategist in here. We're done, Savita. I'm just kidding.
No, absolutely, we are not done with Savita. Savita Subramanian of Bank of America will be sticking with us for the hour, which is a good and beautiful thing. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Anna and Yahaira.
Hi, Lisa. President Trump has signed an order doubling steel and aluminum tariffs to 50% effective today. Trump says the additional levies will support domestic industries and eliminate what he calls the national security threat of imports. Tariffs on the UK will remain at 25% to allow the two sides to work on new taxes or quotas by a July 9th deadline. Staying on trade, U.S.-China negotiations may be keeping President Trump up at night. He posted on Truth Social just after 2 a.m. Washington time, writing, quote, "I like President Xi of China, always have, always will, but he is very tough and extremely hard to make a deal with." The Post is raising questions about whether the two leaders will have a call in the near future, as the White House has promised. And Dutch Prime Minister Dick Schoof has resigned, setting the stage for a snap election. He was forced to step down after far-right leader Geert Wilders pulled his Freedom Party out of the coalition government over a dispute about asylum and immigration policy. Schoof will continue in a caretaker role until a date is set for fresh elections. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, Walking the Walk.
This is a president who doesn't just talk the talk, he walks the walk too, and he's delivering on his promises to bolster our steel and aluminum industries in this country and to protect those jobs.
Wendy Schiller of Brown University joining us next, and can I say, I don't think he sleeps. I think that he is one of those people who just doesn't need it, which is pretty impressive. This is Bloomberg Surveillance. building on 2 straight days of gains as the S&P 500 careens toward that bull market, up nearly 20% since April 8th. Now adding to that with 0.2% gain on the S&P, on the NASDAQ, Russell up about 1/3%. Really, a question is, are people overly shrugging off this question of how feasible is it for Congress to get that big, beautiful bill passed by July 4th? Under surveillance this morning, walking the walk.
This is a president who doesn't just talk the talk, he walks the walk too, and he's delivering on his promises to bolster our steel and aluminum industries in this country and to protect those jobs. If not for this president, that steel plant in Pittsburgh, Pennsylvania would have closed. Those jobs would have been lost, and the president saved that company, he saved those jobs, and he's saving that community.
Here's the latest. President Donald Trump raising steel and aluminum tariffs from 25% to 50%, escalating concerns about U.S.-China trade negotiations. Trump posting on Truth Social earlier this morning, "I like President Xi of China, always have and always will, but he is very tough and extremely hard to make a deal with." Bloomberg's Tyler Kendall joins us from Washington with the latest on whether he sleeps and what is ahead for the day when it comes to some of these trade negotiations.
Yeah, hey, Lisa. Well, it definitely feels like these trade tensions are escalating when it comes to China after the thawing that we saw last month. And former acting chief of staff Mick Mulvaney perhaps put it the most succinctly in an interview with Bloomberg Television earlier this week that there is a, quote, fundamental disconnect here between the two leaders that we're seeing play out. On one hand, we know that China would like to see key advisors iron out the issues before putting Xi Jinping on the phone, whereas President Trump wants to take that call directly, and it appears he wants to take it now. And I can tell you that the sense out of the White House is that officials do feel that direct contact could help perhaps speed up easing some of these differences. I spoke with Deputy Treasury Secretary Michael Falkender earlier this week, who told me eventually these two leaders are going to have to get on the phone, perhaps to address one of the biggest sticking points at the moment for the U.S., and that's accusations that China is slow walking the export licenses when it comes to critical and rare earth minerals that are essential to supply chains here in the U.S. Now, of course, the other side of this is that those accusations go both ways, that both sides are violating the trade agreement reached in Geneva as China raises concerns about new AI chip controls or plans to revoke Chinese student visas as just two prime examples. But Lisa, some pretty incredible reporting from Bloomberg News this morning, which adds a new dimension that we're going to be watching closely here, which is that China is considering buying hundreds of Airbus aircraft in a bid to shore up ties with Europe amid this escalating trade war with the U.S. Now, people familiar caution that the plans are not confirmed yet, but it's likely not welcome news for Boeing or for President Trump either.
Bloomberg's Tyler Kendall, thank you so much. As always, we'll be catching up with you for some more in a little bit. Wendy Schiller of Brown University joins us now. Wendy, wonderful to see you. Thank you so much for being with us. I want to start with the idea of some of these trade negotiations as part of the three-pronged stool that President Trump's administration has put out there. What do you make of the progress being made, both racing ahead when it comes to trade deals as well as the deficit discussion down in Washington, D.C.?
Well, Lisa, I think that they are related in the sense that President Trump wants to shore up, particularly in the Senate now, Republican support for his big, beautiful tax bill and to settle the trade environment and not put inflationary pressures on the U.S. economy and also sort of raise consumer fears about future price increases. That's really important, not only for him, but also for members of Congress that have to go back to their town halls and hear all about people's concerns. First, it was DOGE and the budget, and now it will soon be inflation, deficit spending, bonds, treasuries, all those sorts of indicators of economic health. So it's important for the president to inject, I think, more stability into his trade negotiation persona or platform, because that will also affect Congress's, particularly the Senate's, willingness to try to really pass this bill by July 4th, which was supposed to get passed, as we recall, by Memorial Day, and that deadline came and went.
Wendy, China's lead negotiator with the United States, He Lifeng, says that the nation is ready to discuss all major issues with the U.S. Does that include Taiwan? I mean, what sort of messaging do you take out of that?
Damien, I think it's a treacherous path for the president and his staff to sort of conflate, just conflate tariffs and economic policy with our military stances. You know, he's got a complicated situation with Ukraine, a complicated situation, obviously, with Israel, Gaza, and the Taiwan issue is something that if it's loaded up onto the plate without really a consistent U.S. foreign policy right now, that will complicate his negotiations, not make them simple. And I think the president likes to cut deals, and he likes to cut relatively clear, straightforward deals where he can claim victory. Taiwan's going to be more complicated, and it puts the United States in a position that affects its military stances in other conflicts around the world.
Wendy, Treasury Secretary Bessent's on the tape discussing global imbalances and points to China's inability to shift from an export-oriented economy to one that's driven by consumption. I mean, this flies in the face of decades of conditioning, as Chinese households' propensity to save is grounded in an overall lack of trust on Beijing themselves. So, what do we really hope to accomplish here? What comes next? What is Treasury Bessent really trying to accomplish here? Just curious.
I mean, I think Treasury Bessent has seemed to, from what we can tell, exert influence on the president, right? Stabilizing the president, getting to back off really huge tariffs and trying to add more consistency and more justification for the tariff policy. So I think his public remarks about China and saying, okay, you've got an economy that really depends on the United States consumption tendencies, and we want to produce more of our own goods. Let's strike a balance so that we can do that, and you can still have U.S. markets, but you've got to shore up your own consumptive markets. I think that's a sensible public persona when you're trying to get China to come to the table. What that actually results in terms of internal economics in China, we'll have to see. But on the steel plants, we've lost hundreds of thousands of jobs in steel over the last 30 years. And we can't bring steel back completely at all. And it was interesting that the president's going to take credit for saving existing jobs that are in the United States, and they're relatively small compared to the rest of the economy. So there are some imbalances we will not be able to fix.
Wendy, I'm curious. So we've been in an environment where demand for U.S. assets, bonds, equities is sort of imperiled. Do you see Section 899, which is this remedy against foreign, unfairness in foreign taxes, do you see that as a big hit to demand for U.S. assets?
Well, I think it produces instability. I mean, the president could wake up in the morning or in the early hours of the morning and decide, okay, I'm going to change the rules of the game today. And that just wreaks havoc, on markets, but also on small business people. And then, as they in their own communities get concerned and get worried and think about passing on costs to consumers, then those consumers in those communities start to worry about the economy. And we've seen some real dips in consumer confidence. So I think there are ripple effects to this sort of ping pong or yo-yo-ness of the president's trade positions. And certainly we rely on the rest of the world and internally to buy our treasuries to float our debt. And that's where the really big debt ceiling increase comes in. And that's what Rand Paul is complaining about, that it's not just deficit spending, it's also creating, unsustainable, literally unsustainable debt, because sooner or later people will stop buying it. And if they stop buying it, we have no way of floating our expenses.
Wendy Schiller of Brown University, thank you so much for being with us. It's not just Ron Paul. It's also Elon Musk, who's come out over the past few days and called this bill a disgusting abomination.
Abomination. I love, it's a great choice of words there. No, but I think it is interesting. And some of the congressmen who pushed the bill, they've pushed back on Elon Musk and saying the reason he's not happy is with the EV stations and all the things that are layered in there. So he's got some self-interest, and I really can't argue with that either.
Well, we actually saw Tesla put out something about how these EV credits, if they're taken off, will really push back the industry in a pretty serious way. I'm curious what you think about Section 899 and how concerned you, Savita, are about that possibly getting in through the final bill.
Yeah, I think that Wendy is absolutely right. It just adds to this layer of uncertainty, this inability to actually plan. I think that U.S. bonds are imperiled by this aspect because, again, everything we're seeing right now is putting pressure on the long end of the 10-year. I think, if you're right about the short end, we're in an environment where the yield curve is actually could potentially steepen. I think that's good for some sectors and bad for others.
And that's the reason why people are keeping an eye on that 30-year bond, the risk asset, as JP Morgan's Bob Michael has called it. Coming up, Connor Teskey of Brookfield Asset Management will be joining Danny Berger over in Berlin. He will be talking about mergers and acquisitions under Trump and how much they can revive in the second half of this year. This is Bloomberg Surveillance. make this day 3, the first 3 days of the month of June, potentially following May in very much the same way, which is very much a rally and potentially leading to what looks like increasingly a bull market in the S&P 500, building on gains that are almost 20% since what we saw on August 8th, up about 0.1% in the S&P and the NASDAQ, outperforming yet again this morning the Russell 2000 futures as people take a look at whether maybe some of those smaller companies have been a little overlooked. Right now, we are looking at 3 hours away from the cash open. Your morning movers with Yahaira Anand. Yahaira.
3.6% on big news that the Fed has lifted the asset cap that has shackled the bank since 2018. It marks a new era and is a major win for CEO Charlie Scharf. That's because, according to our calculations, the cap had cost Wells Fargo an estimated $39 billion in lost profit. But now, for the first time in 7 years, the bank can grow its balance sheet, gather deposits, and boost lending, and of course, boost its trading and investment banking. Next up, to the downside, we have shares of CrowdStrike. Those are down 7% now after the cybersecurity company gave a revenue forecast for the current quarter that fell short of analyst estimates. Part of that is fallout from last summer's global IT outage tied to a software update from the company. After that, it offered customer commitment packages, and the CFO says those are still dragging on revenue and will do so for the rest of the year. And to the upside, we'd end with Hewlett-Packard Enterprise. Those shares are up 6% after the company said that tariffs will hit profits less than expected. CEO Antonio Neri saying the impact is more mild than feared. Meanwhile, AI demand continues to grow for the server and cloud software company. It pulled in $1 billion in revenue related to AI, beating estimates, though still trailing its rival Dell Technologies. Though investors seem past that this morning. Lisa?
Thank you so much, Yahaira. On our radar this morning, continuing with the tariff discussion, President Trump doubling steel and aluminum tariffs to 50%. The White House casting the move as necessary to help domestic manufacturers and protect national security. This is a real question, Damien, going forward about whether this is just the beginning of what we might see in terms of sectoral tariffs.
Yeah, well, I think policy transparency, while that is important, policy credibility here is everything. And I think, our last guest just pointed it out perfectly. The uncertainty, the volatility off the back of that, and the inability for businesses to make decisions is really key here.
Yeah, I think that tariffs are being discussed by corporates, though, in a much more mitigation-oriented way. So, it's interesting because our analysts think that at least 70% of companies can pass some or all of the potential price increases on to the consumer. So I think that there are a lot of nuances here, and what we've heard from corporations is far more positive around tariffs. Also, we've seen the rates come down demonstrably, but I think that the idea that tariffs are going to be just an immediate margin hit is not necessarily the case. That oversimplifies the problem.
Well, a little less subtle, perhaps, is the ex-post that we got yesterday from Elon Musk condemning President Trump's big, beautiful tax bill, calling it, quote, a disgusting abomination, saying it defeats the purpose of Doge cost-saving efforts that he had been working on. To me, this really highlights one of two things. Either this shows the divorce that a lot of people thought was going to happen, or the decoupling of Elon Musk and Donald Trump, or it's an apology tour to revive Elon Musk's view in the eyes of shareholders at a time when his companies are feeling the brunt.
It's a very interesting point. Look, Lisa, this comes down once again to credibility, be it shareholder credibility, constituent credibility, and the lack thereof in the Trump administration and those that are affiliated to it. But here's the interesting thing, just to go to that trade argument. What does this all mean? I agree with you. Supply chains can correct themselves. They've proven to be pretty nimble and pretty, given what happened during COVID. But, where are the bodies buried? Who is going to bear the brunt? Is it going to be dumping into emerging markets? Is that going to suppress inflation domestically there, which allows them to cut rates more and stimulate that much more, raising their debt loads? Again, these are the things that you have to kind of think about.
Hold on a second. And Savita, I want your thoughts on that. And this sort of speaks to that. China considering order hundreds of Airbus jets as soon as next month when European leaders visit Beijing. Sources telling us here at Bloomberg that negotiations are still underway. A deal could involve about 300 planes. But really it ups the ante, Savita. And it kind of goes to what Damien is talking about, which is how much China is trying to really reignite some of its relationships with other countries. Right. Europe, emerging emerging markets and using them, sure, as dumping grounds, but also as replacements to the United States.
That's right.
Absolutely. I mean, I think it's just bolsters the U.S. out of U.S. into rest of world trade. But I mean, historically, and I don't know if it's that different today, what's good for the global economy is usually good for the U.S. corporate sector. And I think that could prove to be at least partially true going forward. So when I look at positioning, I don't see investors set up for a global economic boom. I see them set up for stagflation. I see them set up for, some kind of muddle, but not necessarily a global economic boom. I think that's what we should be gearing expectations to, because to your point, we are seeing a lot of signs that the rest of the world can kind of get out of its own way and really do something interesting.
Well, I think, and I think the way that outlet comes out in the market is in currencies. And I think that's what you're seeing right now. That is that's where you see the differentials kind of really hit.
And we're going to be talking about that more in just a bit. Right now, though, I do want to take you back to the Super Return Conference in Berlin, where Danny Berger is standing by with a special guest. Danny.
Lisa, thank you so much. Indeed, I'm pleased to say that joining me here is Connor Teskey, the Brookfield Asset Management President. Connor, thank you so much for joining. Really wonderful to see you here in Berlin.
Thank you for having us. It's great to be here.
Look, it is a first half of the year that's felt like a decade. And within that, Brookfield is very global, from every corner of the world to infrastructure, to real estate, to buyouts. In this moment where it feels like we're rethinking global trade, has there also been a rethink in where capital is being deployed?
There is no doubt that things are evolving, but they're always evolving. This is no different than some of the different trends and supply shocks we've seen in recent years. And what we're seeing on the ground is relatively constructive. Businesses are performing well, capital's flowing, capital markets are very, very robust right now. And the key themes that have been driving our investment in recent years, they're not continuing, they're accelerating.
Surely there's pain somewhere, Connor. I mean, you look at the fundraising for this industry. The first time in the first quarter, no fund has raised more than $5 billion in a decade. So where is that pain if you're not seeing it?
So maybe to contextualize the comment that the sentiment is good, no doubt the sentiment is stronger this year. And the way I'd characterize it is perhaps 12 or 15 months ago, market participants were waiting for pockets of stability to start doing work on transactions or raising capital or large initiatives. This year, it's the opposite. Market participants have done the work. They're sitting there. They're ready to go. The hand's on the button. And if we could get a short period of pockets of market stability, a short pocket of market stability, we think all that pent-up demand and volume of activity that people were expecting at the beginning of the year, we think it unlocks very, very quickly.
What's the likelihood we get a pocket, though? Because it has been nonstop volatility.
We'd be pretty encouraged. And what's driving that is, well, some parts of the market are a bit slower, as you say. Large transactions, certain public market transactions are difficult in a volatile environment. Other parts of the market are seeing tons of activity. Within our private equity business, we're seeing a huge increase of activity in things like partnerships and corporate carve-outs, where you can bring more than just capital, but also operating capabilities to bear. And we're seeing that on the infrastructure side. Just this morning, we announced a $10 billion infrastructure, digital artificial intelligence infrastructure partnership in Sweden. A couple months ago, earlier this year, we launched a partnership with Barclays Bank in the UK, where we're going to partner on their electronic payments business. So we're still seeing lots of activity. Maybe it's just not so much in the buyout business that often generates the headlines.
And it's interesting, as you know, I ask about fundraising. There have been reports, Apollo and KKR have talked about on their earnings call, that there have been some government influences, especially from foreign LPs, to invest in very U.S. type brands of funds. Yeah. Does it help to be Canadian right now?
You know what's interesting is we get that question a lot, and what's sometimes underappreciated about Brookfield is we're known for investing capital all over the world, we also raise money all over the world. And the one thing that is always constant is there is an ongoing evolution of where capital is coming from and where it's being directed. And for years, that's been driven by politics, that's been driven by business performance, that's been driven by liquidity. It does feel a little more sensitive right now because some of it is driven by geopolitics, but the capital reallocations we're seeing are not unnatural in the history of what we've seen, and it's certainly not changing our investment themes or what we're seeing in terms of opportunity or valuations.
To be specific, how is the geopolitics affecting that flow? Is it that your American rivals are getting less? They're looking for other types of funds?
I would say it's different everywhere around the world, and you're seeing it in many different ways. I feel like Europe is getting a lot of focus right now. It's seeing perhaps more activity today than people expected earlier this year. But at the same time, the U.S. is still the largest and deepest market around the world. We've been very active there in the first half of the year, and we expect to continue to be. Large organizations such as ourselves, we're well positioned to navigate some of this uncertainty and perhaps capitalize on the opportunities it presents.
Connor, but before I let you go, I do want to talk about one other risk that's been presented. And it's that AI spend on things like data centers is too much. Joe Tsai of Alibaba has been one of the chairmen over there, said, oh, it's a bubble, we're spending too much. When you're committing these levels of capitals to these huge products, how do you ensure that it doesn't turn from a boom to a bubble?
What's incredible about the capital that's being deployed into AI infrastructure, whether it's the shells or the racks, whether it's the power that supports the data centers, whether it's investing in the chips and the servers, moving up and down the value chain. What's different about this type of investing is it's all backed by long-term contracts with some of the largest, fastest growing, most profitable companies around the world, the large hyperscalers. And that's certainly a tremendous support for the business and gives us incredible confidence. And what we would say is while more and more capital is being deployed into the space, the demand still certainly outweighs the supply. The supply-demand imbalance is in favor of those that can provide that capacity where the market demand is overwhelming.
Well, we look forward to learning about more deals like your Sweden one today. Congratulations on that. And Connor, thank you so much for joining. Really generous with your time. We appreciate it. And Lisa, with that, I'll send that back to you. Connor Teskey, the Brookfield Asset Management President.
Thank you so much, Danny. Great work this morning. And there's a real question and focus around private credit markets, not just in alternative asset management, but also in some of the public markets. And we've seen that increasingly, Savita, even when it comes to equities.
Yeah. I think at the beginning of the year, there was this expectation that we're going to see a massive IPO boom, massive M&A activity, and it's been crickets. I wonder if that changes. I mean, I think that there are a lot of IPOs, like companies waiting or private enterprises waiting to go public that are not tethered to this higher interest rate environment. So I think that's why we've seen this pause in IPOs, is that these companies can't get the prices they want in the IPO market. I think it's interesting, though, the Canada angle. I mean, Canada looks really interesting right now. It's got better balance sheets. It's got, they're selling hard assets, new government. I think this is an interesting area of the economy that doesn't get as much playtime as, say, Europe or, emerging markets. But it's also interesting to hear, the guests talk about, the speaker talk about how they're seeing more opportunities outside of the U.S. than maybe a couple of years ago.
Yeah, a lot of people have been looking elsewhere, potentially, that they've overlooked the rest of the world. Right now, let's get you an update on stories elsewhere this morning. We have not overlooked the Bloomberg Brief with Yahaira Anand. Yahaira.
Thank you, Lisa. Well, Senate Majority Leader John Thune says the House SALT deal will have to change. The House increased the maximum deduction to $40,000 in President Trump's One Big Beautiful Bill, which is now making its way through the Senate. But lawmakers like New York Representative Nick LaLota are pushing back, warning changes could sink the bill. Meanwhile, Maersk saying its U.S.-China bookings have increased after a recent pause in tariffs. The shipping giant also expecting a, quote, tightening space across all Trans-Pacific services in the coming months. Maersk's Trans-Pacific bookings slowed in April and May, with many importers waiting to assess the tariff environment. And shares of Rémy Cointreau are trading higher in Paris. The cognac maker forecasts organic sales growth returning to a mid-single-digit rate this year, but withdrew its long-term sales guidance due to tariff policies In the U.S. and in China, shares of Remy Cointreau are down more than 40% so far this year. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Coming up next, the labor market on hold.
The labor market's in a bit of a holding pattern. I think that's a general nature for the economy as well. So until you really see demand destruction to the point where, like forecasting, you just don't need that labor supply, I think companies are going to hold on to labor, hiring will be moderate.
Michael Reid of RBC joining us next. This is Bloomberg. Building on the gains of the past few days, building on the gains of May, the biggest May that we have seen for S&P returns going back to 1990. Adding to that with just about 0.2 of a gain on the S&P, almost 0.3 on the Russell 2000. Bond yields not exactly doing much, which is a good and beautiful thing. They are, though, creeping higher on the front end. This is the right kind of move that you want to see on the downside on the long end, as there does seem to be this everything rally bleeding demand into duration. Dollar weakness continues and has been a theme over the past 3 months. Under surveillance this morning, the labor economy on hold.
A slowdown in growth is already expected. We've yet to see that in the data. So I'm a little bit, at this point in time, kind of the boy who cried wolf on the data. I want to see the data actually kind of roll over. The labor market's in a bit of a holding pattern. I think that's a general nature for the economy as well. So until you really see demand destruction to the point where, like forecasting, you just don't need that labor supply, I think companies are going to hold on to labor, hiring will be moderate.
Here's the latest. Investors counting down to May payrolls out on Friday. Bloomberg survey looking for 130,000 jobs added and unemployment to hold steady. Michael Reid of RBC writing this: we expect to see 162,000 jobs added. Uncertainty after the 90-day pause meant businesses and consumers likely avoided making major decisions. And yet here he is with some of the higher projections for what we can expect to see in payrolls. Michael joins us now. Thank you so much for being here.
Thanks for having me.
Why is your expectation so much higher than the vast majority of economists out there?
Well, there's a few things going on, and the first thing I always point to when we're above consensus is, look, half of the gain is coming from healthcare, and that's just a demographic story. That's not going to change. We saw a huge number of retirements in March and April. We have an aging of the population, and that segment of the population demands a high level of healthcare services. So that's a huge tailwind for healthcare hiring moving forward. Tariffs aren't going to change that.
So you don't think that we're necessarily entering a period where just structurally the payrolls figures are going to be lower, and that could still be a good market, but it just is demographically what we're seeing? You don't believe that kind of theory?
I don't, not right now. And partly why we believe that is, number one, you have services that are still kind of recovering from COVID. By that, I mean, we mentioned healthcare, but other sectors that are benefiting from that older demographic include leisure and hospitality. That's one that still has to recover from pre-COVID hiring levels in terms of the service that they can provide. So that's another sector that we see as gaining this month. And that's one that we do expect will have a tailwind, again, coming from that older demographic, which tends to spend on services over goods.
Michael, you're at 162 on Friday versus 130 consensus. What do you think that's worth in terms of the equity market? Are we talking 1%, 2%? And for that matter, let's talk 2%. What is that, 200K? I mean, what do we need for that market to kind of shoot up and get really bullish here?
I think the estimates are rather tight. So when you look at the spread, I mean, we're at 160, consensus is at 130. You have a few that I saw come in below 100,000. I think the market gets worried if you get something below 100,000. I think over 200,000, maybe you get a bit more optimism. But for now, there's a very tight range of estimates. Part of that, too, I think, stems from the fact that you have to factor in the birth-death model.
Yep.
And that's something that's kind of mechanical. It's baked in. It has a certain amount of momentum. So for us, when we're thinking about what we're seeing in hiring trends, going from about 177,000 the previous month to 160 makes sense in our view.
So talk about the underlying sectors within the labor force that are still strengthening here. I mean, take us through some of those.
Yeah, well, I mentioned healthcare, leisure, hospitality. Those are quite strong. We expect financial services is one that will add.
Interesting.
And despite some weakness coming from DOGE cuts, professional business services still has the potential to add jobs. Other services is a bit of a mix. There are some sectors there, including kind of those nonprofits that are risk kind of losing funding. So we do have some job cuts penciled in there. Manufacturing as well is one that we do think is at risk of shedding jobs this month.
So over 100, less than 200, Goldilocks. I mean, I'm just going to say it. But I agree with you. And I think what's interesting about what you're saying is that the areas where you're seeing a tighter labor market are high demand from an older demographic and jobs that are kind of hard to replace by AI, bots, automation. And it's kind of interesting because I think healthcare and some of the more labor-intensive areas in the U.S. Equity market, which is my world, are under more pressure than, let's say, I think IT services, professional services, those are areas where they could actually use automation. What do you think about that as a potential, kind of loosening force for the labor market in those areas?
Yeah, I think there's a lot of talk about AI and how that's going to impact the labor market. To us, that's a longer term trend.
Yeah,
that's going to play out over the next 5-10 years. When you think about, and as you rightly point out, there are a lot of in-person service jobs that just can't be replaced by AI.
Right.
Leisure and hospitality is probably a prime example. Health services, another one. Also thinking about other services was one that I mentioned, and I find that to be kind of an underrated sector, right? It's kind of a hodgepodge. You have vehicle repair services in there. AI is not going to replace that. You have personal care services, things like, hair salons and the like.
Right. AI can't replace fingers. I think fingers are impossible to automate.
No, we'll leave the robots to that.
Yes, we need robots for that. What do you think about the idea that deregulation, if it happens, and it seems like it's happening, is negative for labor? Because there are a lot of jobs associated with regulation.
The area where I would expect jobs to be lost if you see some deregulation would be in legal services.
Yeah.
That's already one that's been kind of shedding jobs. I think AI is one where that's kind of infiltrating in more of that entry-level area. So it's already, in our view, on the kind of downtrend.
Got it.
Not a particularly large sector that would kind of move the top-line number.
Michael Reid of RBC, thank you so much. And we do get the ADP employment change coming out at 8:15 a.m. Eastern. That's about in an hour and 20 minutes. The expectation is for 114,000 jobs at a time, when a lot of people are seeing the potential for numbers to come down. And that still not be a bad thing, Damien.
No, it may not be a bad thing. And look, I think the markets, again, you look at recession probabilities coming in, you look at these sell-side indicators at B of A going up, people are getting bulled up here, and maybe they're justified in just that. Oil prices are down, the dollar is weaker. These are good for global growth.
And as Savita has pointed out repeatedly this morning, it feels a lot like Goldilocks, and people shrug it off because it doesn't feel like it, maybe, just in terms of volatility of headlines, but not when it comes to the underlying data.
Right. And I think, but actually the fact that everyone's getting more bullish is more bearish for equities. So that's obviously the counterbalance.
So just, the yin and the yang there of Goldilocks. Savita Subramanian, Damien Sassower, both of you, thank you so much for spending the hour. Really wonderful to have both of you. Coming up next, we've got Kate Moore of Citi, Bloomberg's Tyler Kendall, and Lei Qiu of Alliance Bernstein, all coming up as we get ADP employment. At 9:45 and 10, we get a slew of ISM and S&P services index data. And then later this morning, we do get ongoing discussions about what that economic data means for Friday. This is Bloomberg.
People are still buying U.S. equities, but not buying U.S. bonds.
It's not that people don't want to hold U.S. long bonds. They don't want to hold long bonds.
The Fed doesn't have as much control of the long end as they've had. People are afraid to be bullish.
The most important factor right now in the market is the momentum factor.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back. To Goldilocks, evidently. Global stocks hitting new highs, U.S. equities approaching a bull market, and focus shifting away for the second from Washington, D.C. to any positive news, any positive surprise in economic data. Very happy to say Romain Bostic is joining me for the next 2 hours. Just to remind you, John Ferro is on vacation. This week, we'll be back next. Annmarie is on assignment. Romain, thank you so much for being here.
Absolutely, Lisa.
You had to come in from the close to the morning just because.
I know. It's like wire to wire here. So I finally get to see how you guys do things here.
Yeah.
This is before my wake up time.
Let's see how it works for you, because it's really fun. I am curious about this idea of the bull market and the idea that we were just talking with Savita Subramanian of Goldilocks returning despite some of the uncertainty and the fact that we still have a lot of question marks.
It's kind of insane, right? A couple days ago, coming into this week, someone said, hey, have you actually looked at where kind of the MSCI All World Index is, where the S&P is? And I said, well, yeah, I do every day. I haven't looked at it since, from 4.8, that sort of bottom that we saw after the whole Liberation Day freak out. We'll look at it. You have the MSCI All World Index at a record high today. The S&P still has some room to go, but you look at what's taken us there. Mag 7, 43% of those gains, at least here in the U.S., and a lot of non-Mag 7 companies. But again, it's tech. It is a lot of those, I wouldn't go so far to call it Goldilocks, but a lot of those big names that kind of got us that big rally in 2024 and at the start of 2025.
Yeah, to put some numbers in what you're talking about, we're about 3% from that all-time high on the S&P 500, all world stocks already there. But it is this question of, do people just throw the babies out with the bathwater? And if we just turn to nowhere, because basically we're almost flat on the year when it comes to some of those big tech stocks, it raises a question about how much people have accounted for what is going on in Washington, D.C., the animosity between China and the U.S. that does continue, and this question of whether that big, beautiful bill can actually get through.
Do people have to pay attention to that? Because I've asked this question to so many people, right? We have not seen the real effects of the tariffs and just the chaos in Washington yet. And a lot of folks on Wall Street say that will come. We don't know the severity of it. But in the meantime, maybe you can sort of whistle past the graveyard and look at the complexion of the rally and how many people we've had on Bloomberg who've talked about this idea of this is a retail-driven rally. A lot of the institutions are still on the sidelines, at least not to the extent that what they were prior. And this gets to this idea of participation and whatever conviction there is that has led us to where we are.
And I guess if you push what you're saying forward, which is a really good point, how long can this everything rally continue without the participation of either the dollar or U.S. government bonds? And that raises this fundamental question, does that have to be the linchpin, not necessarily the dollar so much as yield space, for any kind of further gains, or is that now a separate story that can kind of shift on its own business?
Well, short term, history says, yeah, it can. Long term, it says no.
We have that conversation coming up. Right now, we are building on gains after 2 straight days of gains. We are building and looking for a third, with people pouring into small caps in particular, up about 1/3%. You can see S&P futures up at 0.2%, as well as the NASDAQ. Yields quiet. And this, again, raises the question, what is driving the long end and the short end? Right now, people are seeing positive news as possibly shifting yields marginally higher on the front end. The 30-year getting a bid. This is a risk asset. On days that are risk on, the 30-year does well, yields lower. This has been an interesting trend when you take a look at the dollar space, a little bit of dollar weakness. But this, to me, has been the story of the year so far. Just how much froth has come out of the dollar over the past 3 months, down about 6% over the past rest of 2025. Almost 9% declines. Coming up for the next hour, Kate Moore of Citi, with stocks posting their best 2-day streak since mid-May. Bloomberg's Tyler Kendall, as President Trump's big, beautiful bill faces Senate roadblocks. And Lei Qiu of Alliance Bernstein on growing AI spending opportunities. We begin this hour with stocks steady, holding on to 2 days of gains ahead of more labor market data. Kate Moore of Citigroup writing this: we view the market as exhibiting the relief due to the recent tariff roadblocks. However, uncertainty remains, and corporate management teams will resist large capex and hiring plans until further clarity on trade rules. Kate joins us now with a dose of cold water on the Goldilocks.
Sorry.
It is so good to have
the porridge is too cold apparently this morning.
Well, I'm just wondering, what do you make of all this Goldilocks talk? Not all this Goldilocks talk. Savita Subramanian was just talking about that, but this feeling companies will adapt and adjust and get it through, and that's what we have continued to see.
Yeah, look, I have all of the faith in large cap companies being able to adopt. But we don't know what they're adopting to. And this is the big question mark. Everyone says, okay, we're going to get past tariffs, or we're going to get past the worst in terms of tariff news. But we know that all of these sectoral tariffs can have much greater impact than some of the reciprocal tariffs. And if I was a company making investment decisions, this is what I was writing in that note, I would say, like, I can wait it out for another couple months or another quarter or two before I make decisions, because I want more clarity into what my margin story is going to look like. And I think that's a prudent thing to do. And it is the behavior that these large cap companies have exhibited through many years, over a decade at this point, and really managed their bottom line. It's one of the reasons why we love them, and one of the reasons why we want to continue to own them.
And there's this larger question, and we were talking about it at the open, this idea of how long can this sort of feeling of adapting, adjusting continue without recognizing the structural framework that could be shifting. We just got news that the European Commission is recommending that Bulgaria joins the euro next year. There is this question about whether the euro is getting fortified as a viable alternative to the dollar at a time where we have seen the dollar really lose steam. How much do you give credence to that? The idea that outside of the U.S., you can rely more considerably on the adapting and the adjusting, and the framework remaining the same.
I think it's too soon for us to call the end of dollar dominance, not just because of trade, but because there is, to this point, not a viable alternative. But I think all these moves on the margins are very much worth watching. Like, if we see different governments, if we see different policymakers, if we see different investment communities start to take a good look at other currency alternatives and just incrementally shift their own positioning, and many of them do it at the same time or over a number of years, that can really start to move the needle. I think most currency strategists would agree the dollar was a little overvalued even before all of this stuff. And so kind of we're getting back to a more normal valuation for the dollar. But this idea that we're going to have a massive and consistent decline and there are going to be these viable alternatives by the end of 25, I think is probably too far gone.
And does there need to be a viable alternative? I mean, there's been a lot of talk about this is just kind of rebalancing that equilibrium. And when you look at the currencies that have performed so well over the past few months, you look at the Swiss franc, you look at some of the other European, or even the euro, which that probably won't last. But I mean, let's take the Swiss franc, for example, because I think a lot of people have talked about how a lot of asset managers have shifted some allocations over to the franc as a way to hedge against what's going on here in the U.S. Maybe that's not a structural change, but over time, that can whittle away at the value of the dollar.
What I will say is a lot of our clients, particularly some very large clients, and I'm going to highlight clients in Asia specifically, have been asking about ways to hedge their dollar exposure. They just want to kind of neutralize that in portfolios, and that makes a ton of sense. So we're seeing this across all segments, but particularly the larger clients who have this outsized dollar position, or if we've seen that kind of drift in the dollar position over the last couple of years, looking right now that there's relative stability as an opportunity for making that move.
Is there, though, a long-term case to be made for a certain level of instability, a certain lack of trust in the U.S. system that had bolstered the dollar for basically the last, 50, 60 years?
I think it's a fair question, honestly. And I think as we go through the discussions around tax and as we watch what happens to the deficit, and we understand that there are going to be some significant challenges to the bond market over the next year or two, unless we have a significant reverse, of course, it's fair for global investors to revisit their portfolios and say, hey, we may have the best companies in the world in the U.S., the most innovative, the best free cash generators, but we're not as confident that we should have this much of our fixed income allocation in U.S. bonds. Yeah. And again, this is on the margin. We're not talking about a wholesale reversal. Right. But when this happens over a period of quarters or a period of years, it can have a really significant impact on yields.
But Lisa was showing the 30-year yield at 4.9, and I look at 4.9 and change over there. Let's just round it up to 5.
Yeah.
That's not attractive with a 10-year at 4.5. It's not attractive if I look at the contours of this tax bill. Great. I love the tax cuts. I'm not so great about the fact that they're not making that up in any sort of way, shape, or form.
Right.
So if you're a long-term investor, why would you go longer out on the curve right now?
I mean, we certainly aren't. Like a lot of asset allocators, we've been hiding in the short end, maybe a little bit to the belly, but really being very concentrated there. And we keep on having this debate within the team and across all of the city. At what point do we want to buy duration? And it's not just the level. It's how do you get to that level? What the drivers of that move to that level, and whether or not we feel it adequately compensates us for the risk on the fiscal side, on the risk on the tax side. And, the truth is that growth is okay right now. It's not phenomenal. And we're not looking for kind of a 3 to 4% GDP world or for the U.S. in the next couple of years. So it's pretty tough.
It also raises questions about what drives that kind of desire to own long duration assets. Is it a good thing? The idea of fiscal responsibility or some sort of sense that maybe you can get compensated with this kind of yield? Or is it the idea that we're really going to hit some sort of slow patch? And this is something that was introduced by Savita. At what point are we looking at bond yields going up as a positive thing? Yeah. As a sign of risk on elsewhere because it's coming with growth? I mean, can you get your hands around that argument?
I'm not at a place where I think bond yields are reflecting better growth in the future, right? And a lot would need to happen. By the way, I thought the economy was slowing even before the introduction of these tariffs, which I think are quite growth negative, even if, as I was saying before, the reciprocal tariffs don't end up coming through, and we're just talking about the sectoral tariffs. This is a headwind. We just need to acknowledge that. But the consumer and certain segments of the consumer were showing stress at the end of last year and the beginning of this year, even if the aggregate data looks pretty good. And we were starting to see more cautious spending from companies in general after a prolonged economic cycle. So all of that was in place before this uncertainty. So I think it's really too soon for us to say we're going to be able to forecast an acceleration in the U.S. economy, maybe based on tax cuts or based on consumption looking good when there are so many other challenges.
Just to sum up, would you sell this rally?
I would not be adding a lot of equity risk to this rally. But again, I think large caps are going to be the better place within the U.S. market.
Kate Moore of Citigroup will be sticking with us for the next hour, which is a wonderful thing. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. Elon Musk blasted President Trump's tax bill as a budget-busting abomination as Republican fiscal hawks also step up criticism of the package. Musk's attack comes days after he left his temporary post leading government cost-cutting for the Trump administration under DOGE. Meanwhile, the Federal Reserve lifted the asset cap on Wells Fargo that had restricted its size for over 7 years. The Fed says the bank met all conditions required by an enforcement action imposed back in 2018. The removal of the cap marks a major win for Wells Fargo CEO Charlie Scharf and will allow the bank to pursue growth again. Meanwhile, a check on Dollar Tree shares, they are falling 3.5% as the company warned investors that its second quarter profit could be down significantly from a year ago, that overshadowing a strong previous quarter where it beat earnings forecasts and boosted its full-year EPS forecast. The discount chain also expects to mitigate the impacts of higher tariffs. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Coming up next, Trump's big, beautiful bill facing roadblocks.
It'll be the largest increase in our debt ceiling in our history. And I think it's a mistake. I'm not going to be one of the Republicans who's going to be responsible for this debt.
We will not be able to pass the bill without finding some more spending cuts.
That's coming up next. We'll be speaking with Bloomberg's Tyler Kendall. We'll also be touching on the steel tariffs, with which President Trump is shifting to 50% from 25%. You've got the UK Prime Minister out this morning saying that they're working on bringing those down to zero on UK steel. We'll discuss that as well. This is Bloomberg. Building on gains in the equity market in the U.S. and frankly around the world this morning, we're seeing about 0.2% gain on the S&P and on the NASDAQ. You could see gains retrenching just a touch. Similar kind of move right now on the Russell 2000. A question about whether people are paying attention at all to what's going on in Washington, D.C. Under surveillance this morning, Trump's big, beautiful bill facing roadblocks.
It'll be the largest increase in our debt ceiling in our history. And I think it's a mistake. There's no more pointing fingers at the Democrats and saying, oh, they're the big spenders. It'll be all on Republican shoulders. And I'm not going to be one of the Republicans who's going to be responsible for this debt.
I would like to see some reforms to Medicaid.
We will not be able to pass the bill without finding some more spending cuts. We can do that without going after Medicaid benefits.
Here's the latest. A cohort of GOP senators are vocalizing concerns over President Trump's massive spending package. Rand Paul, Ron Johnson, and Mike Lee are among those vowing not to approve the bill in its current form. Bloomberg's Tyler Kendall joins us from Washington. Evidently, Tyler, President Trump is not sleeping. He is talking to all of these senators. What are the biggest hurdles right now?
Yeah, hey, Lisa. Well, he's definitely ramping up the pressure as he faces conflicting demands from Republicans that want to make changes to this House package. And there's a few different factions here. One, of course, is that group that's emerging, pitching themselves as those fiscal hawks that you mentioned a few of the names there that want to see some deeper spending cuts. Now, of course, we also saw this on the House side, and that package is ended up projected to add $2.5 trillion to the deficit over 10 years. But perhaps these senators might have a little bit more leverage because they're not up for re-election as often, so could push President Trump to make some changes. One of the biggest sticking points is going to be lifting the debt ceiling to this package. You have Rand Paul saying that he won't vote for a package that hikes the debt ceiling, whereas Ron Johnson has said perhaps he could vote for a one-year increase. But then you have other Republicans saying that they want an even bigger increase than the $4 trillion currently allocated in the House plan because they don't want to have to deal with this until after the midterm election. Other than that, of course, this squares with the idea that there are some Republicans that are concerned about what spending cuts could look like, particularly when it comes to benefit programs, that speeding up of the work requirements connected to Medicaid, also plans to freeze the Medicaid provider tax and shift some of the cost sharing on to states. Lisa, I really could keep going, of course, because this is one big, beautiful bill. We're also looking at some of those, what the tax cuts could look like. But at the end of the day, President Trump can really only afford to lose 3.
Well, Tyler, let me stop you there because I am curious just about the math on this. And maybe you can help me. I've got 5 fingers. We put 5 people up on the screen there. We can take 2 of those guys out because we'll know they'll flip-flop, and you know exactly who I'm talking about. A 53 majority, right? 53 is what the Republicans have right now. So even if they lose Rand Paul, even if they lose Johnson, isn't that still going to be enough, maybe, assuming that they can sway Tillerson Lee to flip-flop? Isn't that still going to be enough to get this bill through?
Yep, it ultimately will. So Republicans can only afford to lose 3 senators. That's the key math that we're watching here because they chose to do this through reconciliation, which means they only need that simple majority so that they can fast track this legislation. So they don't have to negotiate with Democrats, but they do have to negotiate with each other. But we really are starting to see some of these senators dig in on some of these key issues, such as changes to Medicaid, which we know will be a politically fraught issue for the White House ultimately. And then, Romaine, we have to keep in mind they're going to kick this back to the House, too. And that's where we're starting to see some of these disagreements really creep up into the conversation, such as changing when it comes to lifting that SALT cap. We know House Speaker Mike Johnson has urged senators not to change this bill too much because that was one of those key sweeteners to ultimately getting it over the finish line. At the end of the day, we do know President Trump has a key meeting today, 4 p.m. Eastern at the White House. That's with members of the Senate Finance Committee. Romaine, as you well know, these are really the senators tasked with writing the bulk of the legislation when it comes to both Medicaid and those tax cuts.
Tyler Kendall, thank you so much, as always, for your great reporting. And this has been the issue, the SALT tax cap, and whether they do lift it the way that the House bill has said. One, just congressman, to your point, Nick LaLota, a New York Republican, came out last night after seeing that some senators had proposed taking out some of the caps or lowering that cap area. No SALT, no deal, for real. On X.
This is getting messy, but it's going to get to the point. They're just going to have to pull some stuff out of this if they want to get this through. It's just a question of what.
Exactly. And Kate Moore of Citi is still with us. And Kate, I'm curious how closely you're watching this and how much you think this has been driving some of the action that we've been seeing, not only when it comes to bonds and the deficit, but also with equities.
Yeah, I've been watching it really closely, but it's one of these things where the market can only pay attention to one thing at a time. And there are moments when it pays attention to the tax bill, but I don't think that's what's getting reflected in prices today, for example, or the move higher in futures. I think people are reflecting the fact that growth looks okay, and that the likelihood that some of these reciprocal tariffs are going to be biting in the near term is low. But the tax bill is a really hard one to handicap at this point for all of these reasons. Lots of different personalities. There's lots included in the tax bill. And the likelihood that what we saw in the House version ends up in the Senate version, that ends up getting voted on, is close to 0.
You talk about the big personalities, and
Yes.
I'm going to get you into trouble, so good
Okay.
luck. I'm
My
curious.
best. Yeah.
Elon Musk last night saying, "I'm so sorry, but I just can't stand it anymore. This massive, outrageous, pork-filled congressional spending bill is a disgusting abomination." Definitely one for some pretty good hardcore language here. Shame on those who voted for it. You know you did wrong. You know it. I mean, how do you view this type of rhetoric coming out of the best buddy, the first buddy of President Trump, but also a very big business owner who's been very polarizing?
Well, thanks for remembering and reminding me, I'd say, about pork. When we thought about politics and we learned about this in U.S. history and pork and bills, I had forgotten that term until just this moment. But I do think this conversation is important. And I think we're going to see more and more of the debate played out on social media, on TV interviews, in op-eds. And that noise is going to make it very difficult to meet that July 4th deadline, in my assessment. I'm not going to comment specifically on Musk, but what I will say is some of this pushback from Republicans and from Democrats who are concerned around the deficit going ever higher without any governor on it, I think is a very fair concern and something we should be discussing. It goes in not just to the bond yield, but also to the sustainability of U.S. growth.
I mean, and, let's take Musk out of this because it's not clear how much influence he's going to have. I do wonder how much influence the market will have. And I know there was a lot of hay made over whatever happened in early April with that, let's just say that move in the bond markets, whether that was directly related to it or not. I am curious if the market, has the capacity to push back on this and more importantly, the willingness.
I think at the extremes or at speed extremes, I would say the market is really sending signals to all of these different political leaders and policymakers. But, if it's kind of a little bit of a grind in one direction or another, I'm not sure it's telling them much, or they're going to pay that close attention to it. You get the big gap downs or the big moves up. People feel concerned or significantly more confident.
But this gets to like the way Lisa started this hour, which is, we have stocks, at least on a global basis, back to record highs. The S&P on its way. Yields are in check. I mean, maybe not where they should be, but they're relatively in check. The VIX is subdued. And I guess with the exception of maybe the dollar, I mean, most asset classes are faring pretty well.
Yeah, well, I think there is a lot of complacency in the market, I would say. The move in May was fast and furious. The decline in the VIX also catching my attention. And again, I don't think it's reflecting the balance of risks in 2025 or into the beginning of 2026. And this is accepting, what's going on in the tax bill.
And this is the reason why so many people have said the pain trade is higher, because from a logical perspective, the uncertainty doesn't necessarily feel great. But at the same time, what you have seen is just climbing that wall of worry and grinding higher and higher.
Yeah, Lisa, can I just make a point here? I've been talking to a lot of investors, institutional investors around the street, my community, and also, through official meetings, we'll say. And everyone is talking a more cautious story, right? They're concerned about growth. They're concerned about what could happen to earnings. Many people share my view that 2025 consensus estimates for U.S. large cap earnings are a little bit too high. But no one is really positioned for it. I mean, in the worst case scenario, people are neutral. And I would say we're neutral on equities and still, as I said, have this preference for large caps. But I think this is important because the gap between narrative and action is pretty high right now. People expressing concerns but haven't acted on it. That said, if there are significant issues that actually show their ugly heads over the course of the summer, the beginning of the fall, I think there is room for people to cut risk.
That is a reason why people say, honestly, if one bad economic print, if you get a bad non-farm payrolls number, and it won't happen on Friday, but if it happens in a couple months' time, that's when the proof really is going to be in the pudding.
And inflation data as well. We have a lot of people saying, look ahead to June and July, where maybe you'll start to see the impact show up.
Of course, then you're going to start talking about transitory, and then we'll play the drinking game, and then we get back to this question of what the Fed does with it.
Oh, is there drinking on this show?
There is.
Okay.
There's drinking coffee, although, you can put whatever you want in here. Coming up, Kate Moore of Citi is going to be sticking with us. Lei Qiu of Alliance Bernstein will be joining us on growing AI spending opportunities that has once again emerged as the golden child of a market that just can't quit. This is Bloomberg Surveillance. Just 2 hours until the start of the open, and you can see futures heading on and building on 2 days of gains, with a third seemingly underway, up only 0.1% pretty much across the board. Kind of the opposite of what we had been seeing over the past few days, starting softer and then building into the open and then onto the close. Are we fading into the open today just a touch after reaching all-time highs on the world equity indices and really getting only 3% away from that here in the United States? With your morning movers, let's head over to Yahira Anand. Yahira.
Hi, Lisa. We start with some M&A news. Driving these two stocks this morning, we have Chart Industries up about 0.3%, Flowserve down 2.5%. The Wall Street Journal reporting the two companies specializing in industrial process technologies are close to merging. They're reporting this all-stock deal would be worth roughly $19 billion. I will also add, we have seen signs of life in M&A this past week. We had some pharma deals and as well as Snowflake buying Crunchy data. We'll see if that momentum continues. Next up, we have CrowdStrike sinking here. It's down nearly 7% after the cybersecurity company gave a revenue forecast for the current quarter that fell short of analyst estimates. Part of that is fallout from last summer's global IT outage tied to a software update by the company. They're saying that after that, it offered these customer commitment packages, and the CFO is saying those are still dragging on revenue and will continue to do so for the rest of the year. And last up, we do a check on Wells Fargo. Those shares are still up 2.6% on the big news that the Fed has lifted the asset cap that has shackled the bank since 2018. It marks a new era and a big win for CEO Charlie Scharf. That's because, according to our calculation, the cap had cost Wells Fargo about $39 billion in lost profit. But now, for the first time in 7 years, the bank can grow its balance sheet, gather deposits, boost lending, and of course, ramp up its trading and investment banking. Lisa?
Thank you so much, Yahira, and really builds on this question of how much this administration more broadly will unshackle some of the risk-taking that big banks have been curbed from taking over the past few years. On our radar this morning, President Trump raising steel and aluminum tariffs to 50% from 25% today. The new levy is kicking in just after midnight Washington time. The White House saying the tariff increase will support domestic steel production and serve as national security protections remain at a time when a lot of people are wondering, have we fully factored in what sectoral tariffs could be coming down the pipe?
No, we haven't. I mean, that's really clear. I mean, we haven't. I mean, you can see that in the price action. You can see that when we speak to analysts here. The idea here is that no one really knows, so no one really can price that in. Look, he went through on those tariffs as he promised, and as, Caroline Levitt made clear, he walks the walk, and at least he did on this particular issue. The problem is there are about 20 other issues that still have to be resolved.
Yeah, and this is one of the things when we've looked at guidance, when we've looked at earnings revisions, which, these two things should be somewhat related. We can't really tell if companies have any visibility, beyond the next 2 or 3 months. And that's largely because they don't know how to handicap these sectoral tariffs. They don't understand how deep and painful they might be for kind of next year. And so as a result, they're only making these tiny, cuts on the margin to their guidance. That's getting reflected in analyst revisions. So it doesn't look so bad, but it's more about paralysis than actually a continuation of where things were in 2024.
Also, you wonder about just the cost aspect of it, too. Like when we had the pause on tariffs, and I forgot which pause it was, there were a couple of retailers saying, okay, now we're going to start ordering a bunch of stuff now.
Totally. Bring it forward.
But how does that sort of end up impacting margins and bottom lines? Because you're now at a completely different model here that is it's like a stair step. It could be 10% here and it could be 20% the next month, or it could be 0 if you are in paralysis, like Kate said.
Or potentially you could end up with a lot of inventory with a style that completely changes, and suddenly Lululemon pants are back and going to work, and suddenly, you have to really shift your entire inventory. Meanwhile, there's a real question
about...
I
don't own any Lululemon pants.
Really?
Are they popular?
I've actually heard that from men
I actually sleep in my suit, by the way.
I think that you do. I can see that, actually. Senate Majority Leader John Thune, meanwhile, talking about suits, saying the $40,000 SALT deal that helped President Trump's tax bill pass the House will have to change in his chamber. This is kind of the key question. Negotiations are ongoing as a cohort of GOP senators continue vocalizing their concerns with this bill. The SALT tax, such a huge point of contention, which is a no-go for a lot of particularly New York and New Jersey Republicans.
I will say that if there are any group of politicians right now that might hold the line when it comes to this bill, it is going to be the New York contingent, because this is obviously a big issue for at least voters locally. Whether that's going to be enough to completely derail it, who knows?
Yeah.
Yeah.
I mean, right now people are looking at whether we end up having some sort of come together moment for the Republicans, or whether we could actually go beyond that July 4th.
But isn't Trump going to, at some point, he's going to, use that bully pulpit? I know he's supposed to meet with a lot of these folks today in Washington. At some point, he's going to use that bully pulpit and probably threats and say, look, get on board or else.
President Trump is not shy of using the bully pulpit. And President Trump was posting on Truth Social his favorite bully pulpit last night, quote, saying this, or this morning: "I like President Xi of China, but he is very tough and extremely hard to make a deal with." The post raising questions about the state of U.S.-China trade negotiations. And Kate, I'm curious about whether this idea of the relationship between the U.S. and China has fully been teased out in markets, given the fact that these are two economies that are intricately intertwined, that have largely been decoupled, in fact, when it comes to the shipping volumes over the past month.
Yeah. Well, I think let's step back outside of these tariffs and say China and the U.S. were in a period of really intense strategic competition for a long period, for the last couple of years. This, transcends Democratic and Republican administrations. This is just kind of the state of play. And what's happening right now is an acceleration of this decoupling, an acceleration of this strategic competition. And one of the things I'm watching, and again, these are just little snippets on the sidelines, is what different companies and countries are saying about aligning with China versus aligning with the U.S. We need to remember that there are many countries out there for whom China is a much more important trading partner than the U.S. And if that's the case, then, we can push on China as much as we want, but we may drive away other countries and companies that may be partners.
Well, there was a story today about the European Union and that deal for Airbus planes with China.
Yeah, and potentially whether they end up having a closer relationship. This really goes to the heart of tech.
Mm-hmm.
And I think that we have to really focus in on tech. NVIDIA shares staging a $1 trillion rebound over the past 2 months, leading investors to believe there is more room to run in artificial intelligence. Lei Qiu of Alliance Bernstein writing, "There seems to be continued skepticism over the return on investment of AI, but we believe we are at an inflection point where we are seeing real AI revenue from privates and publicly traded companies." Lei joins us now. Lei, thank you so much for being with us. Just to build on the conversation that we were just having, how does the sort of ongoing tension between the U.S. and China and where people will source their technological instruments, how does that factor into how people evaluate some of the tech behemoths that are benefiting from the AI trend, but it depends on where and how and in what bulk?
Well, I think, first of all, it seems like there's a lot of controversies in tech, and particularly with all the tariff that's going on. And that really highlights tech is sort of the epicenter of it. Tech is strategic. At this point in the economic cycle, how good you are in technology really define how superior you are as a company or as a nation. So we should just assume that uncertainty and this back and forth on tariff is here to stay, and it will continue to drive volatility in the tech sector. But that said, I would also say, because tech is so strategic, we just really look at, instead of trying to figure out the supply chain, maybe it's more important to focus on who has pricing power, who can actually pass on the pricing, right? Because we can analyze the chip, where it came from, where is it assembled, and ultimately where's the final goods coming from. You can do it all day long. What's the point of doing that? But what's more important, perhaps, is just to see how strategic the product is, how differentiated it is. Can anyone else make it? Can you do without it? And that's kind of a starting point.
So that raises a really good question, and it's a fabulous point. How much are you seeing the hardware continue to be the point that has pricing power versus the software of how you apply it?
Well, I think there's hardware and there's hardware. There's the hardware that is really unique and you absolutely cannot do without, right? That's why there are certain giant companies with huge market cap, because you can't do without it, because we're at the beginning of a compute paradigm shift, and that's perhaps once or twice in a lifetime. So That's at the hardware level. You want to find the most strategic asset. But then when I say like there's real applications already in AI, you're seeing it as certain it's not so much software, but you're seeing at large language models, and you're seeing new applications coming up already. So ultimately, if you look back, we have benefited tremendously from these huge network effect companies, and it's asset light. And we're used to thinking, okay, that's where the strategic differentiation is. But going forward, perhaps how we think about the network effect is also changing, right? Everything is being disrupted with AI. And I always say this, historically, tech has the ability to disrupt all the other industries. We've gone through digital media versus traditional media. We've gone through brick and mortar stores versus e-commerce. But AI is unique in the sense that it's redefining tech. So it's actually disrupting tech itself. So rather than saying it's hardware or software, you really have to focus one by one and to see which one is going to be the new leadership in a new paradigm versus what has been.
So does that mean this becomes kind of like a winner-take-all situation, or is there going to be room for everyone?
And historically, I think, I always say historically, because you go back in history and go through product cycles. And I think what we've seen is initially there'll be a lot of companies coming up, but everybody can benefit from, entry barrier coming down. And, everybody says, I can do this, I can do it cheaper. But over time, most of the time in tech, it is winner takes all, right? Because ultimately, if you're truly unique and you can deliver something no one else can do, and you are constantly innovating itself, then you can actually take majority of profit. So it's almost usually like an 80-20 rule, where the bigger ones will take 80% of the profit.
Yeah, so I want to tie this back into the conversation we were having around China a moment ago, because I hear you on the winner take all, that there may be a couple big companies that really dominate. But is it possible that we have this parallel or kind of bifurcated system because chips can't make it from one country to another? How do you think about the opportunities in AI in China versus the opportunities in the U.S.?
Well, I do think, and we just assume the political situation is what it is and it's a given, that we do see China developing its own proprietary system and they're going their way. And currently, a lot of it is still based on some of the U.S. technologies, but they are moving pretty aggressively further, and there's a lot more available data in China also. Yeah. So, and then there are a lot of companies going pretty aggressively at it. So I wouldn't put it out of realm possibility that, the Western world goes one way and China will continue to move forward. But all that said, it's just assumed the current political situation is what it is.
Do you believe, and just to finish up here, this idea that Jensen Huang has talked about, the fact that China is really close to the U.S. and can create their own. Could you see a time, based on your understanding of the technology, where that supersedes and becomes more dominant in the rest of the world? Because there might be a divergence between these two economies, but not in the rest of the world that might have access to both.
I think it's probably too early to tell. It's certainly the way that it's going right now, where U.S. is going one way and China is pushing forward in their own way. And I would say, let's wait and see. It's really too early, and we're really only at the beginning.
2025, the year of wait and see. Lei Qiu of Bernstein, this was wonderful. Thank you so much. Please do come back again. We have been talking about this at a time when big tech, once again, front and center when it comes to U.S. exceptionalism, although is it really global exceptionalism?
Yeah, well, I thought it was interesting. There was a great story in the Bloomberg today about how Thrive Capital, Jared Kushner's firm, Capital Group, had actually made this trip over to China specifically to seek out AI opportunities. You had that deal with Butterfly, that deal with Manus. I don't know how that's going to sit with the president in the White House, but there obviously are U.S.-based investors that do see opportunity over there and aren't just going to sit by idly and let China take everyone's lunch.
Yeah, just if Washington, D.C. has an issue, they're not going to have an issue, because at the end of the day, money speaks. So let's cut you right now an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. The Office of the U.S. Trade Representative has sent letters to trading partners to remind them of an upcoming deadline in tariff negotiations. The White House says the letters are a friendly reminder and that the president expects good deals. Reuters earlier reported that the administration drafted a letter demanding countries provide their best offers by today. Meanwhile, Airbus shares are rising in Paris trading. Sources telling us here at Bloomberg that China is considering placing an order for as many as 300 Airbus jets as soon as next month. The order would be a significant win for the company, which has gained an upper hand in the Chinese market due to trade tensions and issues affecting its rival, Boeing. And shares of Hewlett-Packard Enterprise are rising more than 6% in the pre-market. The company reported quarterly revenue that topped estimates and said it expects a reduced impact from tariffs this year. HPE has been one of the companies benefiting from the rise of AI with increased demand for its servers and other hardware. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, a bit of caution.
We do remain a bit more cautious on the long end of the curve because you've got to ask yourself, are you being adequately compensated to take that long duration risk given the current U.S. fiscal situation?
Molly Brooks of TD Securities coming up next. This is Bloomberg. When you look at equities right now, it feels pretty great, at least after the past couple of days and after a May that was the biggest May going back to 1990, the biggest return that you've seen in 18 months. We have been building on that for the past 2 days with the biggest two-day gain going back to mid-May. In the bond market, it has been more of a question mark. Can you get that kind of rally? Right now, you are not seeing it at the front end of the yield curve. 10 years and 2 years, you are seeing up about 1 or 2 basis points. The 30-year, though, getting a little bit of a bid. At least it isn't rising, which is, I guess, a relief. 4.98%, still hovering near that 5% level with a real question about this risk asset. Under surveillance this morning, a bit of caution.
Parts of the bond market we really like. The short, the middle part of the curve, high quality spread has been a key part of the portfolio, but we do remain a bit more cautious on the long end of the curve because you've got to ask yourself, are you being adequately compensated to take that long duration risk given the current U.S. fiscal situation?
Here's the latest. The U.S. 30-year underperforming short-term debt year to date as investors continue to monitor fiscal risk, leading to speculation the Treasury might scale back or even halt auctions of its long bond. Molly Brooks of TD Securities writing this. Rates have been very focused over the last weeks with passage of one big beautiful bill. However, if we see the macro data turning, the markets will react to recession risk. Molly joins us now for more. It's sort of a question of what would you like to focus on today for every market, it seems like. Molly, I want to start with that. This question of if we get negative economic data, do you believe in your core that 30-year yields will truly rally substantially and could even potentially outperform?
I think that they would probably rally, however, not as much as the front end. In the last couple of weeks, we have seen kind of the correlation between the 2-year and the 30-year declining. So that's showing that the 30-year isn't being driven right now as much by Fed cuts and macro risk. It's being driven more by deficit concerns and concerns of the quality of the long bond. So I do think that while it'll rally on Fed, you'll probably see the front end rally a little bit harder than the long end there.
Is there a risk, though, at those two worlds kind of converging, meaning the concerns about what's going on with the deficit and obviously the macro read-through?
Yeah, I mean, at some point, if 30-year yields increase enough and they're high enough, then conditions are going to be tight enough that we might see that feed through to growth. Mm-hmm. And then that would therefore be feeding through to Fed cuts as well. So it's kind of circular in that you could see that the pure level of the long end bond is impacting growth concerns.
But what becomes that light? Because we kind of already know what's in the bill. I mean, you can model out the increase in debt servicing costs based on what we know already. So what becomes that light that the market is going to look to as sort of, okay, now we finally reached that Rubicon? Is it the labor market? Is it, as you said, actual economic recession of some sort? What?
I would say they don't really need a recession in order to begin this rally. Mm-hmm. Investors might need more of a kind of catalyst that is more recessionary for them to actually be able to jump into longs, just because we've been burnt a lot in recent weeks of just kind of sell-offs here. But I do think that if we see any type of weakness in the labor market specifically, and on Friday specifically the unemployment rate, that's what the Fed is going to be looking at. So if we're seeing the unemployment rate rising and rising quick enough, that's when markets are going to start get concerned, and that they're going to react to the likelihood of Fed cuts in the near term.
Molly, I wanted to ask you, because I've seen a lot of wringing of hands and gnashing of teeth ahead of all these auctions in recent weeks. People have been really stressed about it, and of course they've gone really smoothly. You know, if it's not the auctions and we continue to get that bid, what should we be watching to really kind of signal a meaningful change in the direction of yields, especially at the long end?
Yeah, I think right now, I would say stay focused on the macro data. The Fed has continued
to be... Is it payrolls, do you think, or at this point?
Yeah, I would say less so the headline, but we're looking more at the unemployment rate, just given that it's a little bit more of a clear signal there. So if we see unemployment rate go up to 4.4, 4.5, that's when we think the Fed will get concerned, and that's probably when we'll see most investors more comfortable to step in.
Kate, I'll turn that question back to you. I mean, how much do you expect this to really turn from supply concerns that have been on the peripheries but really aren't center stage? How much will that shift immediately the second we get some sort of pessimistic print in the data?
Well, I think we have to be very careful around the labor market, because this is the place where, to this point, it's been holding strong. And in fact, we've seen companies continue to hold on to their workforce, to not really engage in widespread layoffs. But when you peel back the surface, much like if you're peeling back the labor market report, you do find that there are pockets of companies that have been trimming on the margin, or, and this is something else I've been watching really closely, have stopped filling their open requisitions. Lots of job openings, but whether it's a CEO or the CFO or some HR manager saying, you're going to hold off there, I mean, that on balance shakes people's confidence in the labor market and their future earnings. And so if that then feeds through into consumer spending and these, I mean, there could be this sort of slow-moving domino effect impacting growth in the second half of the year. And that's kind of what I'm watching.
And that's just hard to wrap my head around. I assume that has to just make your job, Molly, just a lot harder.
Definitely makes it more interesting. It's seeing how does this pass through come through. We saw soft data versus hard data, the whole debate on does soft data turn into hard data. We're seeing kind of weakening in different areas of the labor market, to your point, that are maybe not the traditional headline payrolls. And so it's when does this hit these big numbers that then kind of scares the market into rallying a little bit sharper and pricing in more Fed cuts.
Molly Brooks of TD Securities, thank you so much for being with us. Molly Brooks there. I am curious about what we see from ADP in about 20 minutes time and just how much that's going to really have ramifications for markets. It seems like we get it every month. Before we get it, people say we don't care about it at all. And then it happens and it confirms some bias and then the market moves.
Yeah, we don't care until we care. But I mean, just like we never cared about JOLTS until, a couple of years ago. And I am curious about that. I mean, we had a JOLTS report that I guess seemed to show, at least on the surface, I know underneath the hood, there was some issues, but on the surface, if people are still hiring, people are still putting out job openings, that has to be a positive sign.
Yeah, it was. I think it calmed on the surface. But again, when you peel back the layers, not all of it was as strong as we would have wanted, or was kind of, let's say a year ago. There's a lot of data on the year-over-year basis when we look at May and early June data that really does look to be weakening. And this is kind of broad-based. And again, I'm not super bearish, but I want us to be cautious on the second half.
How do you determine, though, normalizing or weakening? Weakening, but not weak. Do you buy that?
I mean, it's hard to tell. Here's the other thing I'm going to say, and Molly just touched on this a moment ago. This translation from soft data into hard data is inexact. We don't have the timing on it. But survey data, I think, will be really important for spending in the second half.
All right, we'll keep our eyes on for that. Kate Moore of Citi, thank you so much. That was wonderful having you for the full hour. Coming up in the next one, Jim Caron of Morgan Stanley, Sucharita Kodali of Forrester, Kathy Bostjancic of Nationwide, and EU Economy Commissioner Valdis Dombrovskis. Don't miss that. This is Bloomberg.
Uncertainty affects the economy in a variety of ways.
The economy is much better shape than people think.
The economy slows,
but doesn't tip over into recession.
The choppiness that we're talking about, we will come through that hopefully with stronger economic elements on the other side.
We're calling this the summer of mud. It means that we're just stuck in this muddle through.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back. Not a mud kind of day, a bull market kind of day. Here in Goldilocks from Bank of America's Savita Subramanian, with the S&P only 3% away from its all-time high. Global stocks already there, with investors moving past worst-case scenarios despite ongoing disagreement in Washington, D.C. A new day of data, of trading, of an investors pushing past the word uncertainty. Romaine Bostic here with me, which is a wonderful thing. Romaine, it just seems like people have just stopped caring about what happens.
I think so. I mean, maybe it's numbness. I don't know. And then you feel like, okay, well, you have to be a part of this rally. And there's a lot of FOMO, too. We've heard that from a lot of folks, that as you started to see this market grind higher, people were saying, look, I want back in. You heard that from a lot of wealth managers dealing with high net worth individuals. Didn't necessarily hear that from the institutional side, but certainly on the retail side.
What we were just talking about with Kate Moore, I think we should pick up this idea that everything is good and fine and feels like a bull market and feels like Goldilocks until the data tells us something different.
Yeah.
And that is the reason why at this point, any print that doesn't show negativity is confirmation that we're okay to go, and it's sort of a green light to keep rallying. But if we get that negativity in some kind of key metric, suddenly that picture changes.
And I do wonder, like, is it going to be just one report that does that, or do you need to have that proverbial string, a trend, if you will, 2 or 3 reports to kind of confirm that data? And also the severity of it, right? If you do see a spike in unemployment, how much does that spike have to be to really rattle investors?
And we are just about 15 minutes or 13 minutes away from ADP employment report. Then we get some services data, both from S&P and the ISM, and this follows what we saw from manufacturing earlier this week. It seems like people are shrugging off all of that kind of negativity as it passed, and the idea of what we see in terms of economic surprises being positive as really the road forward.
Well, I'm glad you brought up the ISM stuff, because, I mean, we saw the manufacturing data. It was awful, but we expected that to be awful. Services, I mean, that could be a key here. And I think Kate Moore was getting at this in the last hour about what we saw in that JOLTS data. The headline number was great. Underneath the service, you did see a lot of weakness when it came to the services industry, particularly hospitality, travel, leisure, basically the discretionary side of this economy.
And it goes to the point that you were talking about at the outset last hour in terms of how long can big tech continue to power the entire sphere of U.S. equities, because that is what we've seen over the past couple of days.
Absolutely. And if just you to put a finer point on that, I was saying, you look at the rally off of that April low, about 43% of that came from the Mag 7, about 50 from big tech. That's actually, believe it or not, a smaller percentage of the contribution to those gains than what we had seen when we were talking about this in 2023, 2024.
So does it have to broaden out for this to be sustainable? That was a discussion back in the day. It hasn't been as much of a discussion in the past couple days. Right now, what we are seeing in markets is more positivity, but fading from some of the earlier highs, just about 0.2% on the S&P and on the NASDAQ, up about a third on Russell 2000. In the bond space, you could see it's pretty quiet, not a lot of drama, but on the long end, just a touch lower, which is a good news, but still creeping toward that 5% level on the 30-year, 4.97. Meanwhile, in the foreign exchange space, you could see the dollar continuing its weakening trend, but just nothing really dramatic. The euro gaining just a touch after that announcement that Bulgaria has gotten the green light to join the euro as the common currency. We'll be talking about that more with Valdis from Dombrovskis later on this hour. Coming up this hour, Jim Caron of Morgan Stanley on how he's rebalancing his equity exposure. Kathy Bostjancic of Nationwide Mutual Insurance reacting to the latest jobs data. And as we were talking about, the EU Economy Commissioner, Valdis Dombrovskis, on both the euro as well as trade negotiations with the U.S., which, those two are still continuing. We begin this hour with stocks higher after posting back-to-back gains. Jim Caron of Morgan Stanley writing this: "We have rebalanced by increasing equity exposures, not just in the United States, but also Europe, our highest conviction overweight." Jim joins us now. Jim, thank you so much for being here.
Thank you, and good morning to both of you.
Good morning.
Well, it's a real question here going forward about how much this long Europe trade was just a trade or whether it's something that actually can stick. You're making the argument, even with the recent gains in the U.S., you would still be a buyer of Europe over what we've seen.
Yeah, it's really about balancing. So it's not that we don't like the U.S. We just think that Europe has a higher risk-adjusted return profile. They've got fiscal stimulus. They've got monetary stimulus. They seem to have their inflation a bit more under control. Plus, a lot of the investment and a lot of the money that's being put through whether it's the defense spending or it's through infrastructure spending, all of this is actually a positive for them. And essentially, we also have to recognize that their valuations, they're a large cap value area for the markets. People are trying to diversify their portfolios from large cap growth and tech into something like large cap value. Europe is actually the poster child for that in our view. Plus, you get to invest in an asset whose currency is appreciating relative to the dollar, so you get a tailwind.
Okay, I want to pick up on that because we've been talking to your colleagues over the past couple of days, and this is the point that I think is fascinating. Morgan Stanley sees everything rallying except for the dollar. Yeah. This idea that you could see rates rally, and even in the U.S., you could see equities rally, even in the U.S., but the dollar is going to be the continuing weakest person in the boat. And I'm just wondering at what point that really is the entire trade that you're talking about here. It's a currency play more than anything else.
So I would say it's a rebalancing. It's a global rebalancing. So if we look at the Fed's broad nominal trade weighted dollar index, the dollar has appreciated in value since 2010 to the end of 2024 by 40%. So essentially, the rest of the world became overweight U.S. assets. They had to buy U.S. dollars in order to do that. Now, you have growth coming in other parts of the world. This is the rebalancing. What that means, and we're doing it too, right? We are actually overweight European equities. So we are seeing other opportunities in other parts of the world. The U.S. markets are going to do fine. It's just that it's not the only game in town anymore. So ultimately, what that means is that if the U.S. has a deficit, which it will have a deficit, the dollar needs to adjust lower to get foreign capital to come in. So all of this is part of a readjustment. It's not necessarily a bad thing. This is a very common, normal readjustment that's taking place, and we want to get on this.
But do you have conviction that it will last?
I do. I think this is a long-term thing. The dollar rally lasted for about 14 years in the period that I'm talking about, 2010 to 24. I think this is a multi-year process. This is a multi-year trade reset. Tariffs, we all know this is going on too. This is a trade rebalance and a trade reset. We get these types of cycles every 15 to 20 years, and we're just starting one right now.
But there's a reason why we kind of had that advantage here in the U.S. because we were the growth story globally. And I get this idea that, okay, the fiscal constraints in Europe are loosening just a bit. China and other parts of the world are going to try to sort of fill the void of where the U.S. is pulling back. But at the end of the day, I'm still not seeing a growth story in Europe, or maybe there is one.
Well, I think there is one. Europe doesn't have sectors like large cap tech, right? So you're not going to see, a stock go up like 200% or something like that, like we have in our large cap tech spaces. So I think this is more of like a slow grinding move. When I look at PEs and I look at multiples and valuations, if I look at as much as I can a like for like company, say in the financial industry, a big bank in Europe, big bank in the U.S., the PE multiple trades at about a 40% discount. And I'm not saying that they should be absolutely equal, but what I am saying is that Europe has a lot of catch up. It's going to be a slower, stable, lower vol, higher Sharpe ratio, higher quality.
And it's going to be more than just defense contractors?
I think so. Because what we have to understand is that an ecosystem gets created. Once Europe decided to spend about close to €1 trillion in stimulus, which they did back in February, early March, you start to develop an ecosystem. You have to develop supply chains. You need energy security. You need to reshape your economy. You need housing if you're going to build more industry, potentially even data centers. So there's a big ecosystem that's starting, and I think that's underappreciated by the markets.
Let's take a step back, because right now we're talking about where is the best place to find value in a ship that is undefined, which is the global economy and where we are in terms of the U.S., and whether we're entering some period of stagflation-like behavior, whether we're going to have higher inflation and faster growth, or whether we could see an outright recession. And that really matters for all of this in terms of the adjustment of portfolio management. I just wonder how you're viewing the data. We're getting the ADP data just coming up about 5 minutes away. We get the jobs report on Friday. How do you view that within this paradigm of understanding, okay, should we shift around a little bit more to duration? Should we shift a little bit more to risk?
So, the data has been disappointing to the better side of the equation, right? So many people have been focusing on, we're going to fall off a cliff, we're going to fall off a cliff. We've been talking about this, the markets have been talking about this since 2023. We're going to have a recession, we're going to have a recession in 24, we're going to have a recession, and it really hasn't happened. So ultimately what this is really down to is the consumer and the jobs report. So if you have a strong labor market, reasonably strong, and we saw that from the JOLTS data yesterday, then what you have is a consumer that stays relatively robust. You can't really have a recession, a deep recession in the U.S. unless the consumer rolls over. What you end up having is a mid-cycle slowdown. So everything that you're saying matters. There's a lot of uncertainty. But look, people were telling me by June we'd have empty shelves in stores and things like that. It's not here yet. The data, I think, the jobs data will get a little bit worse going forward. That's anticipated. I believe that's going to happen. But ultimately, if the confidence in the U.S. in terms of the direction that it's going with the economy, I think that keeps the confidence alive. And remember, it's deregulation, it's tariffs and taxes. We can't focus on any one. It's the package that we're focusing on. And right now we're hearing the tax component, which could be stimulative, and that could actually, be helpful to employment.
We'll be talking about the package throughout the hour, and Jim Caron, we're very happy to say, will be sticking with us for the hour. We're not just talking about that. We're talking about other things as well, including that ADP data coming up. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. U.S.-China trade negotiations may be keeping President Trump up at night. He posted on Truth Social just after 2 a.m. Washington time, writing, quote, "I like President Xi of China, always have, always will, but he is very tough and extremely hard to make a deal with." The post is raising questions about whether the two leaders will have a call in the near future, as the White House has promised. Meanwhile, shares of Hewlett-Packard Enterprise are rising more than 7.5% in the pre-market. The company reported quarterly revenue that topped analyst estimates and said it expects a reduced impact from tariffs next year. HPE has been one of the companies that's benefited from the rise of AI, with increased demand for its servers and other hardware. And the New York Knicks have fired Tom Thibodeau after their first appearance in the Eastern Conference Finals since 2000. Thibodeau is credited for helping take the team out of a slump that saw it make just three playoffs just 3 times between 2010 and 2020. Thibodeau faced criticism that his hard-driving style and over-reliance on his starters wore down his players. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. I wonder, I know they make a lot of money.
Yeah.
But don't you think it still hurts to get fired? Or do you think it's sort of expected?
It still hurts. Yeah, but look, he had to go.
Okay.
I speak for all of New York.
Okay.
He did a great job. He gets a pat on the back, but they need somebody to take him over the hump.
And maybe next time they can actually win. Come on, Up next, the morning calls, plus breaking jobs data and Sucharita Kodali of Forrester with the retail outlook. That is coming up next. Welcome back. We are getting some jobs data. The ADP payrolls data just crossing. Let's get right to it. Michael McKee, Bloomberg Economics and Policy Correspondent. What do you see?
A lot of people questioning ADP, but this number will get your attention. Just 37,000 jobs created during the month of May, according to ADP, in the private sector at least. Last month, they said there were only 62,000. They've revised that down to 60. But the number of private sector jobs, according to the BLS, was 167,000. So take the ADP number for whatever you want, but it does suggest extreme weakness. If that carries through to Friday, we might have some Fed officials paying attention to that. The change in employment was pretty much all in service-providing jobs, 36,000. And of those, 38,000 were in the leisure and hospitality space. That's because professional and business services, education and health services lost 17 and 13,000 jobs. Manufacturing jobs, according to ADP, down by 3,000 during the month. So this is definitely the worst ADP number we have had in quite some time. The question is, how accurate will it be when matched up against the Bureau of Labor Statistics numbers on Friday?
Mike McKee, thank you so much. And you are getting a market reaction. The 2-year down markedly, down to 3.93%, was significantly higher earlier. You are seeing across the board a bid into bonds. Before we continue, Jim, how much do you end up actually looking at an indicator like this?
Look, like we were saying, this is a leading indicator into what we think is going to happen to Friday payrolls. It's not always 100% correlated to this, right? We saw that in the last run of this number, but it does make the Fed probably have to step up and look, because the thing that they're worried about the most is a softening in the jobs market, and if this is the first indicator that this may be happening, then like Mike McKee is saying, they're going to sit up and take notice.
Which is the reason why there is just a touch of a move, even though people say it doesn't matter. When it comes out and it's like this, it starts to matter just a little bit. Time now for the morning calls. First up, Needham downgrading Apple to hold, saying increased competition poses a near-term threat. Next up, JP Morgan raising its price target on Amazon to $240, citing better than expected earnings and China tariff relief. And finally, Oppenheimer upgrading Dollar General to outperform, seeing resilience in an increasingly uncertain backdrop. Sticking with retail, Dollar Tree shares sliding, the company reporting better than expected earnings, but warning of a tariff-driven profit hit in the second quarter. Joining us now is Sucharita Kodali of Forrester. And it really goes to the heart of the question when you see Dollar Tree and Dollar General pitting against each other. Is this an execution question or is this a macro question?
It really is a macro question. There is no question that there's just a lot of uncertainty around what will ultimately happen with tariffs. It seems like we are headed toward a direction where this is ultimately a lot of political theater. However, the exception to that is that there will be permanent repercussions in China, with China and with U.S.-Chinese trade. And a significant part of the discretionary items that both Dollar Tree and Dollar General sell are imported from the Far East. And those are definitely going to go up. Dollar Tree already has raised prices on a lot of goods. And it sounds like they are expecting that there will be more of that in the back half of this year.
Is there some sense, though, that maybe they can make up for some of that gap with an increase in sales itself? There's been a lot of talk about the trade down that we've seen from some consumers. I know that hasn't directly, or I guess in wholesale, benefited the dollar stores in the same way that it, say, benefited Walmart. But I'm curious if there is a case to be made for that.
For sure, there is a lot of ability for everybody in the mass merchandise sector to pick up share from other retailers. You do have sectors like sporting goods and apparel, which are doing very, very soft. So where are people spending instead? They are going to the dollar channel. They're going to mass merchants like Walmart, and they are going to the club channel like Costco. So Dollar Tree is absolutely a beneficiary of that, and they will make up some volume. But the question is in which categories. It's most likely going to be in those essential goods. It'll be household goods, consumables, less in things like party items, seasonal items, which do tend to be discretionary and which are going to be very, very vulnerable to the tariff impact.
I'm curious what this means for a company like a Five Below, which reports earnings after the bell. And I mean, obviously not everything there is Five Below, though I do want to point out, Sucharita, they do have quite possibly the best assortment of Haribo gummy bears on the face of the earth. So there's that. They've got that going for them. But in terms of dealing with their inventory, their supply chain, and the tariffs, are they in the same boat as the rest?
They are essentially, Five Below has become a small format toy store. And so it is, I would say that it is basically the discretionary items at Dollar Tree just expanded into the entire store. So even though the company has outperformed the market year to date, I am very nervous for them. I think that a lot of the same headwinds that other sectors, that other companies in discretionary sectors are facing, Five Below is absolutely going to be facing as well. They do not have the essential goods that Dollar Tree has. The most consumable items they tend to have are candy, which are very, very discretionary. Mm-hmm. So I think that the tariff situation is actually more of a challenge for Five Below than it is for the Dollar Channel.
So how do you see the demand from the retail client? So just the consumer coming in. I mean, you mentioned prices are increasing. Can they handle those price increases, or are these price increases too much? And is that going to erode margins, do you think, further?
We are hearing that there are actually quite a few suppliers overseas that are picking up some of the price increases. We are hearing the merchants pick up some, but there are absolutely price increases that are being passed on to shoppers. We see that in, again, those sectors like apparel. You're seeing it in footwear. You see it in many of these higher ticket discretionary goods that may be targeting higher income consumers. So that's absolutely where we're seeing it. Now, the interesting irony of that is that it is likely the inelastic goods, so a lot of the essentials that could probably bear the biggest price increases, but that's not where we've necessarily seen the price increases yet. But I expect that many of the grocers, the mass merchants, will likely pass on price increases toward the back half of this year, much like they did during the pandemic. And then we risk triggering inflation issues. Inflation seems to be under control right now, but I think that's the big question mark for the economy, because if inflation goes up again, many of our concerns are back on the table.
So I think that's pretty interesting, right? Because this has been the big debate so far in the economy. Who bears the price of the tariffs? Is it the companies, or is it the actual consumer? And actually what we're seeing is that it's kind of a split. It may not be an even 50-50 split. It really depends on the item, if it's a consumer discretionary or if it's an essential item. But in terms of how you see this progressing out going forward, if we just roll the clock forward and let's say we get some normal tariff rate that sort of comes through, does this have a long-lasting impact, or are we just going to look back at 2025 as sort of a one-off minor price shock and we just continue to carry on our way?
I do think that if the global tariff rate ends up being in the 10% range, it is going to be that latter scenario that you described, which is that there is that shock. And I do think that economists, even in the White House, believe that it will basically reset expectations, but then you sort of revert back to the mean. And that is, I think, ultimately the hope. The hope also of many of these negotiating tactics are that these other regions of the world, these other markets with whom we do trade, will somehow be able to find dollars, or they're able to pony up some support for the United States to either reduce our debt or do something that helps the U.S. economically, even if it is not paying tariffs.
It's super informative.
Yeah, Sucharita, Kodali, always wonderful to get your view of Forrester. Really appreciate that. Do want to bring this to you. The ADP number came out, and we have some truthing. We have President Trump out on Truth Social saying the ADP number is out. Too late, Powell must lower the rate. He is unbelievable. Europe has lowered 9 times. Just expect this drumbeat to continue anytime there is some negative economic data.
Yeah, I'm trying to find the 9 times. I know the Europe has lowered significantly, but it gets to this idea here as to what a rate cut would actually do right now in this particular moment. I mean, I understand why the president is doing this jawboning, but even if Powell came out at the meeting, when I think they meet next week, right? Next Wednesday. I mean, what exactly would that do in the short term?
So, I mean, I think Powell is not going to just jump out and cut interest rates at this point. We can't compare the U.S. to Europe. Europe is in a very different situation, different inflation dynamics, different labor dynamics that are taking place there. I think this is kind of an easy, I'd say it's more of a naive observation to compare the ECB to the Fed at this point. So I just think this is jawboning. I don't really see much.
So you just went out there and called the president naive.
2 weeks.
No, I'm kidding.
Well,
I'm just playing. I'm just playing around. Coming up, we've got Kathy Bostjancic of Nationwide Mutual Insurance looking ahead to Friday's payrolls report. As we do get this ADP report, and Jim was making a very important point, which is that you're at a very different place when you look at Europe and you look at the United States. We'll be talking about that and much more. Taking some heat out of the gains that we'd been seeing earlier this morning in futures right now. After that ADP payrolls report came in with a pretty significant downside surprise, you could see stocks actually now lower on the day, at least when it comes to the NASDAQ, down about 1/10. Nothing
hugely dramatic. But it's notable how different the momentum is heading into the open today than yesterday and the day before. It had been lower and then heading higher. Today it is higher and then heading lower, which is a bit of a departure. In the bond space, you do see yields lower across the board after that print, particularly on the long end. Again, giving some comfort to the idea that maybe duration will rally if there is negative economic news, 4.93% on the 30-year. And when you bleed it through the currency space, you do see the euro near session highs after that ADP report versus the dollar, heading toward 114 even right now. 1 hour away from the cash open, here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. Also moving lower are shares of Dollar Tree. They are down 2%. This is the latest company, the latest retailer to report, and they're warning second quarter profit could plunge up to 50%. That's because they say costs related to China tariffs and weaker consumers are weighing on margins. That overshadowing what were otherwise strong results because they say that like Dollar General, consumers are trading down to their stores. Dollar Tree saying they are seeing more customers with a household income of more than $100,000. Wow. Next up, we have shares of Hewlett-Packard Enterprise moving the other direction, and that is because the company said tariffs will hit profits less than expected. Shares are up 6.6%, and they're saying that AI demand continues to grow. It pulled in $1 billion in revenue related to AI, beating estimates, though still trailing their rival Dell Technologies. And we end with a check on NVIDIA, and the reason I want to highlight this company, even though it's just moving about 0.7%, is because it is now back on top, reclaiming the title as the world's most valuable public company as it pulled ahead of Microsoft yesterday. It has seen a torrid rally in the past month, up 25%, despite all those concerns around export controls and, of course, tariff pressures. Lisa?
Thank you so much, Yahaira. I wonder, Romaine, if Microsoft and NVIDIA have their market cap up each on different platforms and everyone cheers when they cross.
Yeah, they would tell you no, but I'm sure somebody must, right?
Somebody must. We do, evidently, and they probably watch with some curiosity. Meanwhile, more economic data and Fed speak on deck. Michael McKee back with us. After looking at that ADP data, I want to focus on that. What stands out as you parse through those numbers?
Well, really just the overall weakness, Lisa. 37,000 is not very many jobs created, and it is the lowest in just about 2 years. Now, the question is that because companies are just not hiring? It doesn't appear that we are seeing anybody getting fired. Tomorrow, we'll get the jobless claims numbers, and they've been up a little bit, but sort of stuck in a range at this point. We haven't seen a real rise since last October when we had the one-time spike up to 259. And then immediately you can see it came back down again. So the jobless claims numbers aren't supporting the idea of real weakness in the economy yet, but we'll look again tomorrow. And then, of course, on Friday, how does ADP match up against the BLS and the May jobs numbers? We're looking at 130,000. That would be a drop from 177. But each month over the last couple, we've seen jobs come in higher than the forecast. Private payrolls were 167,000 last time, and ADP only said 60,000. So it isn't necessarily a good forecaster for what we're going to see on Friday. The Fed is going to look at all of these numbers and try to put them into context, and they're certainly not going to be moving interest rates in June. So they're curiosities. There's something to watch. Something to try to model, but nothing that is going to move the needle for interest rates.
So we can expect to hear more wait and see. Michael McKee, thank you so much. Joining us now, Kathy Bostjancic of Nationwide Mutual Insurance. Kathy, I just want to pick up on what Mike was talking about, that, yeah, these ADP numbers and necessarily whether it does or doesn't mean for on Friday, the non-farm payrolls report, put that aside. Right now, it doesn't seem like anything can shake where the Fed's approach is, which is to remain on hold.
Yeah, good morning, Lisa. Yeah, they're in wait and see mode. It's just all the uncertainty of policy and most importantly, how the policy changes affect the real economy. There's still a debate about that, on the tariffs, how much of the increased tariff, taxes passed on to the consumer versus eaten by some of the importers. And then if it is absorbed by companies here in the U.S. importing, then that means they may have to offset costs, and then you look to payrolls, right? So, but if it's not, then prices go up. So that's where the Fed's dilemma is. How much are things moving away from their dual mandate on both sides, employment and inflation?
Kathy, when you take a step back, there's a real question that seems to be underlying what everyone is talking about, which is what data is going to move the needle from just being weaker and maybe a healthy kind of weakening that you need to get inflation under control to true weakness, right? I mean, how much are people actually parsing between those two very different distinctions?
Yeah, great question. I think that, from the Fed's perspective, for them to go ahead and I think start cutting interest rates, which was kind of everyone's looking forward to, they probably need to see employment growth, not just cool, but really substantially slow down and maybe even become negative. Because they've got to offset that again against the inflation increase. We think will be temporary, but it could be persistent. What worries me a little bit too on the tariff front is that we keep getting increases in the sectoral tariffs could be still coming, like copper, semiconductor, lumber. And then that means that elongates the price shock, right? It's not all at once. It just keeps coming out. So I think weakest, to me, it's the labor market that matters most, because that's going to drive consumer spending, and that's really the bulk of our economy.
Hey, Kathy, Jim Caron here. Good to see you, my friend. So question I have for you is this really about the employment situation in the U.S.? I know the Fed has a dual mandate, but have they kind of forgotten about their inflation component of this? Not that it doesn't matter to them. We all know it's part of it. But they recently did a review of their policy framework where they're thinking more about the average rate of inflation, which means that you could have a period of higher inflation to catch up for those periods when we were below target inflation years ago. So how much of this is the Fed ignoring on the inflation side and is willing to risk inflation in order to keep the jobs market stable?
Well, hi, Jim. Always good to talk to you. So I think that's sort of what they're weighing right now. I wouldn't say that they're completely ignoring the inflation impact. I think there's a great uncertainty and there's diversity of views within members of the FOMC, where some of them are saying, hey, no, we do need to wait and see. Could this inflation increase that we're still waiting for, by the way, still hasn't really showed up in the data, but we all think, and we do think it's going to happen. But how much is that, so-called temporary, and then how much is it persistent? I think the thing that I look at is also how does that the budget talks, how does that impact growth and inflation for next year? Sort of what we're thinking is the Fed waits until September. By then, I think you're going to get some real clear evidence. Labor market is weakening, the economy is weakening enough that they can say, all right, inflation may be up, but eventually aggregate demand cools. That will help temper inflation. They'll be a little late, I think, to help the economy. So they probably have to go 50 in September, maybe another 25. But then I think that's it. I think they have a short window of opportunity, because next year that we will get some stimulus. It may not be as much as previously advertised, but we'll get some stimulus. And that could keep inflation elevated, could keep the Fed on hold for the entire year.
And look, and I think there's been some lags in terms of just that's the way the data has been coming out through the cycle. So effectively, we had a weaker first quarter. We're likely to have a stronger second quarter. I think some of the Atlanta Fed surveys are showing somewhere around 4% GDP. And then you've got the second half of the year to contend with. How do you, in your calculus, how does this work out in terms of the rate policy path? Because on one hand, they're getting a weak first quarter, a very strong second quarter, and the second half of the year may be somewhat average. I mean, does it really just argue that the Fed stays on hold indefinitely?
Yeah, well, first, on your point is a very good one on the volatility in the GDP measures, right? It's very difficult to parse out what's really happening underneath the headline numbers because of these wild swings in imports. So yes, second quarter, we just went through our numbers yesterday. We're also around 4.5% for Q2, but it's really largely driven by inventories and consumer spending from the handoff from the first quarter. So really March, April, May, June, we think consumer spending softens. As you said, in the second half of the year, we look for substantial weakening in the consumer spending, in the labor market, business investment too. keep in mind, businesses are just on hold. They're not only just on hold with hiring, but also investment. So my view, I know people are kind of jumping to the idea the Fed's on hold for the whole year, or more forecasting that. I think they wait, but I think they still start to cut in September in the fourth quarter a little bit to try to ease some of the downward pressure on the economy.
But those downward pressures right now, Kathy, do rate cuts actually address that?
I think it helps. It's not going to avoid a slowdown. And again, I think the Fed is probably going to be a little late because of the tariff impact on inflation. But I think it certainly helps. If we could start to see a little bit of lowering rates and maybe even long-term rates come down a little bit, that could help lower mortgage rates. It takes some of the pressure off of the economy. I certainly think it's the only tool really the Fed has, but I think it can be effective. What we don't know right now is will tariffs ultimately land, and also we don't know about the stimulus for next year. So still a lot of uncertainty.
When we talk about maybe getting some clarity, so you get sort of Washington sorts out whatever's going on with the budget, you start to see more of that hard data, and maybe that does give the Fed a little bit more confidence to make a decision. The question then becomes not so much are they too late, but do they risk maybe overstimulating the economy in trying to address conditions that might have sorted themselves out on their own?
So I think, great question, but I don't think at this point they're risking overstimulating the economy. I think if anything, they've been hesitant, and they will continue to be a bit hesitant. I think what we're probably going to see is the slowdown in the second half of the year pretty pronounced. But then we will get some tax relief next year. That maybe it's not as stimulative because you're going to have the drag from tariffs and some of the other spending reductions coming in the system. But I think net you do see an improvement in the economy next year because of that.
Kathy Bostjancic of National Mutual Insurance, thank you so much for being with us this morning and parsing through what to expect ahead of that payrolls print that we get on Friday. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief, Yahaira Anand. Yahaira.
Hi, Lisa. President Trump has reiterated his call for the Fed to cut interest rates. His comments come after ADP data showed U.S. hiring decelerated in May to the slowest pace in 2 years. He wrote on Truth Social, quote, "Too late, Powell must now lower the rate. He is unbelievable. Europe has lowered 9 times. But here's a fact check for you. The ECB has actually cut rates 7 times, and it is meeting tomorrow. Meanwhile, Walmart is cutting some jobs in Florida. The company told employees in at least 2 stores that they will lose their jobs if they don't get new work authorizations. Walmart and other U.S. companies are responding to recent Supreme Court rulings that are expected to affect the legal residency of hundreds of thousands of migrants. And the largest U.S. theater chain, AMC, reached an agreement with National Cinemedia to run more advertising spots ahead of movies starting July 1st. AMC theaters will feature a platinum spot that's shown right before the film starts, and it will get a cut of the ad sales, receiving what it described as vital revenue. That's your Bloomberg Brief. Lisa?
Wait, seriously? You can't go to a movie theater right now without getting ads?
As someone who goes to the movies a lot, I don't think we need more ads.
Seriously?
I mean, I deliberately show up like 35 minutes late because I know by the time I get there, they'll still be like showing the latest, Coca-Cola,
Exactly. That's the reason why they have reserved seating in some of these places now. So you can skip that and you don't have to rush there and get there 3 hours early.
Yeah. I don't know why I'm paying for a movie to go see ads.
I mean,
but it's platinum ads.
Oh, geez.
Well, yeah.
Anyway, up next, setting you up for the day ahead. Plus, EU Economy Commissioner Valdis Dombrovskis on trade negotiations with the United States from New York. This is Bloomberg. Taking some heat out of the rally that we've seen over the past couple of days. Right now, you are seeing just a little bit of a retracement in equity futures, but pretty much flat across the board after having been up, at least when it comes to Russell 2000, up about 0.3%. In the currency space, you can see the euro ascendant once again reaching session highs of 114.07 after that ADP data came out in the United States, giving extra fuel to a trade that has been strong, which is strong euro, weak dollar for the bulk of the year. We are discussing this amid discussions in Europe. The EU trade chief saying he had a productive discussion with the U.S. on trade today, and talks are advancing in the right direction. There also have been a host of agreements in the European Union toward a closer fiscal union and bringing in some new members. EU Commissioner of the Economy, Valdis Dombrovskis, joins us now from Brussels. Commissioner, I'm so glad that you're here with us. Thank you. I want to start there. How much are the trade negotiations with the United States the backdrop pushing a lot of European Union nations together and bringing into the fold this morning Bulgaria, which was green-lighted to come join the euro?
Good afternoon. Indeed. Well, I would say all in all, we currently are living in more turbulent times and more conflictual geopolitical situation. And that obviously adds to the sense of urgency for European Union to act and to act in a united and coordinated way. So that's why we have made strengthening Europe's competitiveness and strengthening Europe's defense and security as a top priorities for the European Union right now. As regards Bulgaria's euro area accession, indeed, today European Commission has published a convergence report concluding that Bulgaria is meeting all the Maastricht criteria to join the euro area as of January 1st next year. It's not the final step in the procedure. It's still for euro area member states to follow up on this convergence report and actually to invite Bulgaria to join euro area. We expect this procedure to be concluded by mid-July, but clearly it shows that euro remains open and attractive currency.
Commissioner, one big question has been just how much fiscal stimulus is going to get injected into the European region. There was this deal that people have been talking about to support the economy. How much has the economy been affected by the ongoing trade negotiations, or do you really see robust resilience as the European Union looks to other trade partners?
Clearly, we do see a negative economic impact from the tariffs already imposed on the EU by US and also on uncertainty which those tariffs are creating, as we know that we are also not yet at the end of the negotiations. So correspondingly, we saw it as one of the factors slowing down European Union economic growth this year, and correspondingly we expect only EU economy to grow by 1.1% this year. So from European Union side, we are willing to find a mutually acceptable solution with United States as regards the tariffs, also to put an end to this uncertainty and to avoid further also global economic fragmentation.
If you guys cannot reach an agreement by this, at least the deadline that the U.S. has put on you for next month, have you prepared a package of retaliatory tariffs against the U.S.?
Well, as you know already, when the steel and aluminum tariffs were introduced by the Trump administration against the EU, we already prepared the first set of countermeasures, counter tariffs, but we also suspended these counter tariffs to give negotiations a chance. But we had reiterated that if we are not able to find mutually acceptable solution, we are ready also to put those counter tariffs in place. As regards the first package, which was our response to steel and aluminum tariffs, but also a broader package, which is a response to already further tariffs which had been imposed on the EU. But right now, we are still negotiating. Actually, exactly today, our Trade Commissioner, Maroš Šefčovič, is in negotiations with U.S. Trade Representative, Mr. Greer, and they are making progress.
Commissioner, at the same time, China has announced an agreement to buy Airbus planes, potentially 300 of them. And I wonder how much, while trade negotiations are going on with the U.S., the European Union is moving forward with some sort of discussion with China about tightening ties there.
As regards China, it's worth noting that China is second largest EU trading partner after the US. So obviously for us it's very important to have our transatlantic relations and including trade and investment relations on track, but obviously also relations with China are important, that it's our second largest trading partner. Obviously in relations with China we have also concerns regarding the imbalances in our economic relations, regarding the China's non-market policies and practices. So there are also issues which needs to be addressed.
Going forward, what do you think is going to be the key issue that you would like to see some breakthroughs made when it comes to U.S. and European trade?
I would say it's quite obviously that the key issue right now is to find a solution on our ongoing discussions as regards the tariffs, and we do not have so much time left till July, so it's importantly to resolve this issue, also then to put our relations on overall more positive footing.
Economy Commissioner Valdis Dombrovskis, thank you so much for being with us this morning. Right now, counting you down to the opening bell. Here's what we have ahead. At 9:45 a.m., global PMIs. At 10 a.m., ISM services on Thursday. An ECB rate decision, U.S. trade balance data, and another round of jobless claims. Plus, German Chancellor Merz meeting with Trump at the White House. Friday, May payrolls, and Monday, Apple's Worldwide Developers Conference. Jim Caron of Morgan Stanley is still with us. So, Jim, what is going to be the most important indicator for you that you're watching that actually is somewhat tradable?
So, for me, it's all about employment. It's all about jobs, right? So I think this is the economy that we're in right now. If the labor market holds up, and if there's enough supply shipments coming into stores so that we don't have an inflation shock, I think that is going to be really good news, because it's going to unwind a lot of the negative narrative. Because look, the narrative right now in the market is that, okay, markets are okay now, but the tariff damage is yet to be seen. If it doesn't get seen, then we're in the market for an upside surprise.
Jim Caron of Morgan Stanley, thank you so much for this morning. And Romain Bostic, who's going to be with us here in the building until basically the day that everyone goes to sleep, considering the fact that you're here. I'm just wondering, the idea of the momentum of the market, especially at a time where you're seeing something different today than what we've seen over the past 2 days.
And we should point out the momentum's died down a little bit, despite the fact that we are climbing to these potentially these new highs here. We've seen volume low. We've seen conviction in the trade somewhat muted as well. And I think a lot of that is related to the economic data. We do want to see what that jobs report looks like on Friday and the CPI report next Wednesday.
Yeah, and I think that that's the reason why some people are more focused on the economic data also, because we're not getting as many earnings.
Yeah,
you had been getting all of those earnings. It is over. And so now it really comes to what is the other indicator that could potentially be the risk clearing event.
Yeah, no disrespect to Lululemon, but that's not going to move the market.
Can I just say Five Below is basically wrapped for people who have allowance money.
Yes.
And they're between the ages of 10 and 15.
Yes.
Or maybe 9 and 15.
And adults who are kids at heart, too.
Oh, yeah.
I like my Haribo's.
Evidently. Coming up tomorrow, Lori Calvasino of RBC, Dan Greenhouse of Solis, Tom Becker of BlackRock, and Sundar of JP Morgan. Romain, thank you so much
for
being with us today. This was Bloomberg Surveillance.